Hello and welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. Welcome to another session in the marathon series under the Conquer Prelims 2026 initiative. This is the second session under the subject of Indian economy, and this is Shamka Good taking up the second session. Now, before I start, please do let me know, am I audible and visible for all of you? Those present in the session, please give the confirmation. Am I audible and visible? Great. Thanks a lot. Let's start. So before I start, right now the Unacademy is running an offer where all our courses are available at a discounted price of 19,999. Those interested in enrolling, please check out the details. Once you enroll into our courses, you'll get access to the live sessions as well as the recorded sessions, be it in English language, Hindi, or by the bilingual classes. You'll also get access to the reading material, the mentorship services, prelims as well as mains test series. Those interested, do not miss out. Check out the details by clicking on the link provided in the description below. Now, let me start the discussion. Before I start, here is a very important reminder. Earlier, I've taken the first marathon session. The first marathon session I took was on 17th February. 17th February. In that particular marathon session, I covered national income aggregates. We discussed inflation, discussed taxation, discussed budgeting, and we started with banking. I'm just giving you a reminder because some of you have joined today, might slightly be confused as to what is happening. We started banking. In banking, we covered Reserve Bank of India. We covered multiple aspects, the functions, the sections of RBI Act, etc. And we started with the monetary policy tools. We started with monetary policy tools and we covered the quantitative set of tools. That is repo, reverse repo, CRR, ESLR, standing deposit facility, open market operations, etc. We have covered all the quantitative set of tools and we are supposed to start with the qualitative set of tools, and that is where exactly I'll start the today's discussion. So if you are yet to watch the earlier session, please do watch it because you will feel that I've started midway, but it is not midway. The earlier part of RBI we have already covered. So let's start. Everybody is okay. Can we start the discussion now? The qualitative set of tools. Do let me know. Can we start now? Great. Let's start. So quantitative and qualitative. What is essentially the difference between both the set of the tools? In case of quantitative, the Reserve Bank of India will adjust, will make okay. Please do let me know. Am I audible and visible now? Am I audible and visible? Okay, great. Let's start. So don't worry. Sometimes there will be certain technical issues. Let's start. So what I was discussing was essentially there are two sets of tools. One is quantitative and the second one is qualitative set of tools. What is the difference? In quantitative, the RBI will change the monetary policy tools and this will change the overall money supply. The overall money supply. Whereas in case of qualitative set of tools, it will also change money supply, but we can target specific sectors. We can target specific sectors. So we will be able to target specific sectors, and in these particular specific sectors, the money supply will change. Is everybody okay? Please do let me know. And you will understand when I discuss the individual tools, you will understand how so. So let's start. In qualitative, the first one and the most important one is a rationing of credit, priority sector lending. Rationing of credit, and basically the tool that is used, short form of this, priority sector lending, PSL. Now what is this priority sector lending? The banks annually will have to provide certain amount of loans to identified sectors, to the identified borrowers. The banks will give loans every year, correct? The banks will give loans. The banks will give loans to industries. The banks will give loans to farmers. Banks will give loans to, right, let's say students, etc. So the Reserve Bank of India has a mandate, has a condition. 40% of the loans, 40% of the loans annually issued will have to be given to certain borrowers, identified borrowers. For example, the borrowers such as the MSMEs, micro, small, medium enterprises, the agriculture loans, for example, the loans which are given for export credit, the loans which are given for, right, let's say startups, etc. So essentially understand this, there are 8 categories. I'll repeat, there are 8 categories. So under these particular 8 categories, the loans will have to be disbursed. The loans will have to be given by the bank under the concept of PSL, priority sector lending. Now please do let me know. Out of this particular PSL, all of us know that 18% of the loans will have to go to agriculture sector. I'm pretty sure it's already revised for you. So 18% will go to agriculture sector. Now let's assume RBI will change this from 18% to, let's say, 22%. RBI will change this from 18% to, let's say, 16%. So when this particular number will change, I repeat, when this number will change, don't you think the amount of loans issued in these sectors will also change? Is everybody able to understand? When the numbers are changed, can I simply say the amount of loans issued, amount of credit issued in the respective sectors or the respective segments will also change? So that is the reason I said earlier, when you talk about qualitative set of tools, it will regulate money supply. It will change money supply. But the change in the money supply, when done in specific sectors, it can be done to target specific sectors. And that is essentially the idea of a rationing of credit or priority sector lending. And this is a type of a qualitative set of tool. Is everybody okay? Now, apart from this, variation of margin requirements. What do you mean by margin? Margin simply means the amount of money that you will have to put from your own pocket. Whenever you take a loan from the market, certain amount of money out of the total loan has to be paid by the borrower. Certain amount of money. Now this amount of money that is paid from your pocket, rest of it will be given in the form of a loan by the bank. So that amount is called as a margin. So when RBI will change the margin requirements, if you are asked to pay more amount of money, if you are asked to pay less amount of money, it will automatically change the demand for those kind of loans. So when you change the margin requirements, it will also change the demand for the loans for specific segment. Again, change in money supply in a specific targeted sector. That is qualitative. Third one, regulation of consumer credit. a lot of borrowers in India, right? And this is normally applicable in other countries as well. Lot of borrowers take loan for purchasing consumer goods. For example, we might take a loan to purchase, right? Let's say AC. We might take a loan to purchase, right? Let's say a car. We might take a loan to purchase a TV, etc. So a lot of the loans are taken for purchasing consumer goods. Now, what if RBI will basically tell the bank not to issue more consumer loans or to issue more consumer loans? In either case, and please understand why will RBI do this? If there is too much amount of a credit that is floating, if already there is too much of money supply in the market, RBI doesn't want the banks to give more loans, cheaper loans for consumption purposes. So RBI might simply say, don't right give these kind of loans for the borrowers because they will take these, purchase more and more goods and services. Demand for the goods and services will increase, which can contribute to inflation. So it can either promote more of the loans to be issued for more consumption purposes, or it can target these kind of loans, ask the banks not to give such loans so that the demand can be controlled. So regulation of consumer credit. Next one is moral suasion. What do you mean by moral suasion? Moral suasion essentially means RBI has asked the banks to meet certain guidelines. Let's say to meet PSL criteria. What if the banks do not follow? What if the banks don't meet the criteria? In such cases, RBI will send a warning letter. RBI will basically warn these particular banks. That is called as a moral suasion. And if the banks do not follow, right, just like the experience that I have had or you people have in your homes, initially your father will tell you to study well, right? Basically he will warn you, or your parents will warn you. They'll say you are not doing very well, look at your marks, etc., etc. Now even after that, that is moral suasion, even after that, if you do not do well, if you do not abide by the guidelines, if you keep on violating the guidelines, RBI will impose certain penalties, that is called as a direct action. And finally, publicity. What is the basic idea for publicity? Publicity simply means the Reserve Bank of India promoting, right, knowledge. Reserve Bank of India, right, through advertisements, through ads, to, right, let's say various information tools, etc. By using many of the tools, the RBI will create awareness. RBI will create awareness amongst the customers in the market. That is called as publicity. Now these are essentially the different types of qualitative set of tools. Is everyone okay? Can I move on to the next one now? Please do let me know. Is everybody okay? And I can see that some of you are simply saying, sir, write down everything. No, I don't want to keep on writing down everything. If you want the notes, let me complete the session like I gave the notes for the previous session. Once this particular session is over, I'll give you short notes for revision purposes. Okay, done. Can we go forward now? Right, so qualitative as well as quantitative. These are essentially the most important part and parcel of the functions of Reserve Bank of India. With this, we have completed the functions of Reserve Bank of India. What are the other aspects? What are the other aspects of banking sector? Let's continue. Cooperative banking. What is a cooperative? Cooperative simply means it's a group of 10 or more than 10 people. Please remember, what do you mean by cooperative? 10 or more than 10 people coming together to achieve a common objective. The common objective can be to provide, let's say, sugar in the market. The common objective could be to provide fertilizer in the market. The common objective could be to provide, let's say, textiles in the market, clothes in the market, housing, etc. So whenever 10 or more than 10 people come together, form a group to achieve a common objective, that is called as a cooperative. Sir, example of cooperative. All of you heard of a cooperative by the name of IFCO? Please do let me know. IFCO. Okay. Am I audible and visible? Please do let me know. Just a second. Okay, let's continue. I don't know what is the issue today. There is some technical issue. Let's see if it will work fine now. Okay, so let's go forward. What I was saying was, I'm pretty sure all of you heard of IFCO, right? IFCO is a fertilizer cooperative. It's a fertilizer. It's a fertilizer cooperative. Now, why it was there in the newspaper? Very recently, it was there in the newspaper in the context of the disruption in the fertilizer supply in the international market because of the war that is happening in the West Asia, etc. The prices of the inputs going up, the government of India deciding to ration, right, the supply of gas, etc., etc. So, what are the important points in the context of cooperative? Cooperatives are essentially group of 10 or more than 10 people. And these 10 or more than 10 people come together to achieve a common objective. We have cooperatives in fertilizer. Best example is IFCO. We have cooperative in, for example, milk. Right? I'm pretty sure all of you heard of this. Amul. Right? It's a cooperative in the milk sector. Right? So argument is in the banking sector as well. In the banking sector as well, we have a cooperative. Right? And in the context of banking, because we're discussing banking, what are the important points? The cooperatives in the banking are divided into two types. One is urban cooperative banks, and the second one is rural cooperative banks. Urban and rural. Right? The urban cooperative banks are further divided into scheduled as well as non-scheduled. Okay, scheduled as well as non-scheduled. What is the basic idea for scheduled and non-scheduled? If you are registered with the Reserve Bank of India under the RBI Act of 1934, Schedule 2 of RBI Act of 1934, you are referred to as a scheduled bank. And we have multiple cooperative banks which are scheduled. And we also have many of these particular cooperative banks which are not scheduled. Right? So scheduled as well as non-scheduled. And the cooperative banks can be present in the single state and can also be present in multi-state. If it is present in a single state, please understand, this cooperative essentially will come under the regulation of the respective state. And when I say regulation here, listen to me carefully. Whenever you talk about cooperatives, there is always a debate. There is always a discussion or the concern associated with dual regulation. What is this dual regulation? Dual regulation simply means certain aspects of the cooperative banks are regulated by the registrar of cooperative society. Because the state government, if it is a single state cooperative, state government will set up registrar of cooperative society, and it is this registrar of cooperative society which will regulate certain aspects, not all the aspect, certain aspect. For example, elections. For example, the board of directors, right, etc. So that will be taken care of by the registrar of cooperative societies set up by the state government. Now, if it is present in a single state, it is by the RCS of the state government. What if it is a multi-state cooperative? What if it is a multi-state cooperative? If it is a multi-state cooperative, it is essentially going to come under the central government. Is the point clear? It is going to come under central government. Is the point clear? Now, the cooperative bank, by default, when you say bank, it is involved in the banking activity. Correct? It is involved in the banking activity. And before I go forward, okay, listen to me carefully. There could be certain technical issue today, right? I'm facing certain technical issue. Even if something happens, do not panic. Do not panic. Stay back. It might take 1 or 2 minutes. I'll address it and we will start. Don't worry about it, okay? So when you talk about the banking aspect of the cooperative bank, the banking aspect will come under the regulation of RBI. Is it okay? It will come under the regulation of Reserve Bank of India. Is everybody okay? Please do let me know. And this is essentially the idea of a dual regulation. So when I say the cooperative banks can be single state or multi-state, the banking activities will always come under the regulation of Reserve Bank of India. But there are certain, right, very few of the aspects. These come under basically the state government because they're registered with that particular state. If it is a single state cooperative bank, if it is a multi-state cooperative bank, it will come under the central government. And this is in the context of urban cooperative banks, UCBs, urban cooperative banks. And UCBs function just like any normal bank. Any bank that you must have seen, right? You have seen, let's say, ICICI Bank, Punjab National Bank, State Bank of India. Urban cooperative banks also function the same way. Now, in addition to this, we also have cooperative banks which are rural in nature. Okay, cooperative banks which are rural cooperative banks. And the rural cooperative banks are divided into two categories. The rural cooperative banks are divided into two categories. Now, these two categories or the two layers essentially are based on whether these cooperatives will provide short-term credit to the agriculture or the long-term credit to the agriculture. Short-term or long-term. If it is short-term, these cooperatives are divided into three layers again. We have state cooperative, that is state level cooperative bank. We have district central cooperative bank, and at the lowest level, we have primary agriculture credit society, not a bank. It is basically a society. Is everybody okay? Please do let me know. At the top, we have state level, that is a state cooperative bank. And the second, we have district cooperative, district central cooperative bank. And at the lowest level, we have primary agriculture credit societies. And the primary agriculture credit society is not a bank. It is basically involved in providing credit. It is involved in selling of fertilizer. It is involved in selling of the seeds. It will provide warehousing facility, etc., etc. Right? So whenever you talk about the rural credit cooperative, this is the structure, and it is based on the short-term loans which are provided by the institution. Now, there is also long-term institutions here. That is those particular institutions, the cooperative banks, which will provide long-term loans. And in case of agriculture, generally, what do you mean by long-term loans? The loans which will have a tenure of 5 years. The loans which are given for creation of assets, etc. That is basically the long-term lending institutions in case of rural cooperatives. We have two levels. One is SCARDB, the State Cooperative Agriculture and Rural Development Bank. It is at the state level, and below this we have the local level, that is at the lowest level, the primary credit and agriculture rural development bank. Right? So this is basically the structure of the cooperative banking. Can we go forward? Cooperative banks are important. Please make a note of this. Reason being, cooperatives, multiple reforms are being implemented by the government. For example, if you have attended my current affairs session in the context of urban cooperative banks, you must have come across National Urban Cooperative and Financial Development, right? Let's say the NUCFDC Institute. NUCFDC Institute, which has been approved by the government. It has got the license, right, by Reserve Bank of India. It is overseeing the functions of the Urban Cooperative Bank now. It is overseeing the functions of Urban Cooperative Bank. Right, so these are very important details associated in the cooperative banking and from the current affairs, which UPSC might pick up and ask a question in the prelims examination. Done? Okay, cooperative. Now come to another part of the banking, RRBs, regional rural banks. RRBs essentially. Okay, now there should not be any glitch. Am I audible now? Please do let me know. Am I audible and visible? Now there should not be any glitch because I've changed the camera altogether. Okay, great. Let's start. Don't worry. Right now there should not be any glitch. I've changed the camera. Okay, so what I was discussing was essentially the regional rural banks, RRBs, regional rural banks. Now, what are the important points in the context of RRBs? Point number one, RRBs as institutions have been have been promoted with the recommendation given by Narsimham Working Group, 1970s Narsimham Working Group. And based on the recommendations of this particular committee, the Government of India passed an act, RRB Act of 1976. RRB's Act of 1976. And with the passage of RRB Act, the Government of India started promoting these institutions, that is regional rural banks. The RRBs as an institution initially, again I'm repeating this, initially when we set up, the focus was RRBs will be catering to one or two districts only. Is my point clear? I'm mentioning this because today the setup is different. Today the structure is different. RRBs would be catering to one or two districts, and that too those particular one or two districts which are adjacent, contiguous in nature. But over a period of time, what we have seen is the functioning of RRBs have been affected. The functioning of RRBs have been hurt by multiple factors. And as a result, today, multiple rounds of RRB amalgamations have taken place. Today, we do not have these kind of numbers of RRBs. There was a point of time when we had too many RRBs, hundreds of RRBs in India. Today, the number of RRBs has been brought down to very less, hardly around 20 to 30. That is basically done by the Government of India because remember this, Government of India owns 50% in the RRBs. Is the point clear? 50% of the ownership or the equity or the investment promoters, it is basically held by the government, 50%. The state government has invested 15% and the banks essentially are those particular banks which are basically the public sector banks or scheduled commercial banks to be precise. These are the banks which have invested, set up the RRBs and will manage the RRBs. For example, State Bank of India has acted as a sponsor bank. Punjab National Bank is a sponsor bank, etc. So 50% center, 15% state government and 35% by the sponsoring bank. With this idea, we have set up the RRBs. They have worked. They have operated for more than 50 years now. RRBs have completed 50 years. Be very careful. But there were certain concerns regarding the functioning of RRBs. Because RRBs were essentially targeting certain types of borrowers who found it very difficult to get access to institutional loans. What do you mean by that? Farmers, the small and marginal farmers, the artisans, carpenters, small and micro industries in the villages, etc. So the target was essentially to provide institutional loans to these kind of borrowers. Is everybody okay? But at the same point of time, when you provide loans for these kind of borrowers, there is also a very high amount of a risk because the borrowers will default on the repayment. The borrowers will delay the repayment, right? These are very risky sectors, etc. And that is the precise reason the RRBs over a period of time have incurred losses. The NPAs have been very, very high. And that's the reason the Government of India has gone for consolidation. 4 rounds of consolidation has happened. Now, from the last year, the Government of India has implemented one state, one RRB policy. Right? This is update. Okay, one state, one RRB. Right? One state, one RRB policy has been implemented where remaining RRBs in a state have been amalgamated. In each of the state, there will be only one RRB. Done? Okay, so these are certain important points in the context of RRB. Can we go forward now? Okay, one of you is saying that there is a lag. Is it the same for others also? Please do let me know. Is it the same for others also? Only one person is saying there's a lag. My dear, please hit the refresh button then. Please hit the refresh button. Okay. Next, differentiated banks. Differentiated banks. Differentiated banks also referred to as niche banks. Niche banks. What is this idea of a differentiated bank or a niche bank? Whenever you talk about the banking sector, there is universal banking. That is, these are the banks which will provide almost all the services. It could be primary functions of a bank, they will do this. It could be secondary functions of a bank, they will perform that as well. But please understand, there are certain banks which RBI will basically limit in terms of the functions that they will perform. RBI will promote, RBI will ask them to provide the functions or will provide services. But RBI will simply say, these are the only services that you are allowed to provide. Beyond this, I will not allow you to provide more services. These are called as differentiated banks or niche banks. For example, RBI has been promoting differentiated banks such as payment banks as well as small finance bank. What is essentially the difference between both of them? Listen to me very carefully. The payment banks are a type of a differentiated banks which have been promoted by Reserve Bank of India, wherein you will have to have a minimum net worth to invest and start this particular, right? Let's say the payment bank 100 crore rupees, and you can provide the services, but very limited services. For example, you can collect deposits from the customer, but RBI guidelines basically say you cannot collect more than 2 lakh rupees per customer. Is it okay? You can collect the deposits, no worries. But you are not allowed to collect beyond 2 lakh rupees per customer. Right? That is a condition. And some of you might be thinking, sir, why this kind of a condition is there? We should not impose any conditions, etc. RBI simply says we cannot allow every banking unit to start working like a universal bank from the beginning. It is very dangerous because they are going to handle complicated functions. They are going to handle precious money of the customers. What if they do not have sufficient expertise? What if they don't have experience regarding handling the money of the customers, etc.? So that is the reason these kind of restrictions have been imposed. So payment banks, you can have minimum amount of investment. If you want to bring in FDI, even that is allowed. You can bring in up to 74% FDI and start a payment bank. But you cannot collect a deposit more than 2 lakh rupees per customer. You cannot give loans to the customer. But when you provide the services, you can provide certain value addition services to the customer. No loans or no credit related products can be provided by the payment banks. Done? In addition to this, do they come under, right, let's say the other regulatory guidelines? For example, should they maintain a capital adequacy ratio? RBI says yes. They should maintain a capital adequacy ratio of 15%. Remember, 15%. Payment banks are supposed to maintain a capital adequacy ratio of 15%. Right? They will also have to invest 75% of the deposits that they have collected in government securities. Remaining 25%, they can keep it in the form of deposits with other banks. So this is one type of a niche bank, that is a payment bank. Then there is a small finance bank as well. Small finance bank. Yes, FB. What is this idea of a small finance bank? This is one more type of a differentiated bank promoted by the Reserve Bank of India. The small finance banks will basically focus on unserved or underserved borrowers. Is the statement clear to all of you? The small finance banks will focus on unserved or underserved borrowers. For example, micro and small enterprises. Right? Or very, very small farmers. That is basically the farmers who are cultivating on 1 piece of a land. 1 hectare of a land. Up to 2 hectares of a land. Right? So there are very small number of farmers like this. We will have to target those kind of farmers. So the idea is we should target those kind of borrowers who find it very difficult to get access to institutional loans in the market. And that is the reason the PSL, For the small finance bank, the PSL, that is priority sector lending, initially to begin with was 75%, but later on RBI has reduced this particular PSL number to 60%. Even for urban cooperative banks, earlier the PSL number was 75%. RBI has changed these particular norms for even these particular banks. Is everybody okay? Right, so small finance bank. Will they come under the regulations of Reserve Bank of India? Other regulations, for example, Basel norms? Yes. Should they meet the PSL number? Yes. Should they keep CRR and SLR? Again, answer is yes. But please understand, apart from bringing them under the regulatory purview of the Reserve Bank of India, RBI will impose certain restrictions regarding the services that they are going to provide. That's the reason these are called as differentiated banks. Is everybody okay? And these are also there in the newspaper because RBI will impose conditions if you want to basically, let's say, convert. If you want to convert from a payment bank to a small finance bank, RBI says, yes, you'll have to meet these conditions. If you want to convert from a small finance bank to a universal bank, again RBI says, yes, I'll give you license, but these are the conditions. Done? Everybody is okay? Please do let me know. So these are certain types of, let's say, the differentiated banks. Now let's go forward. Basel guidelines. Basel guidelines. What are the important Basel guidelines? Please focus on that. Basel, first and foremost, it's a place in Switzerland. Okay? Basel is a place in Switzerland. Right? In Switzerland, there's a city. And there is, let's say, in this particular city, Bank for International Settlement, BIS. And within the BIS, we essentially have a Basel Committee on Banking Supervision. We have Basel Committee on Banking Supervision. And what is the role of the Basel Committee on Banking Supervision? Every now and then the members of the BCBS will convene and they will come out with set of guidelines or the framework which is applicable to the banking sector. Applicable to the banking sector. It is done in order to improve the health, protect the health of these financial institutions. Done? Okay. So, how many guidelines or how many rounds of guidelines have been announced so far? 3 rounds. Basel I, Basel II and Basel III. 1, 2 and 3. The Basel I already compliant. India is compliant with the Basel I. It was announced very long back, by the way, 1988. It was announced very, very long time back, 1988. So Basel I guideline basically found that there is a risk of losses in case of a bank or it's a financial institution which is involved in lending activity. Bank will give a loan, and when the borrower doesn't repay the loan, there is always a risk. Risk of what? Risk of losses arising because there is no repayment done by the borrower. To address this, there is a capital adequacy ratio that was implemented under Basel Guideline 1. Capital adequacy ratio. CRAR, or else also referred to as CAR. Is everybody okay? CRAR or CAR. Now, basically, what is this capital adequacy ratio? You calculate what is the total risk-weighted assets of a bank. Total risk-weighted assets of a bank. Right? What do you mean by risk-weighted assets? Banks are giving loans. Banks are investing in bonds. Banks are holding lot of other instruments. Banks, let's say a lot of systems, operations are involved. So because of all of this, the bank might incur a loss. Simple. Because of all of this, the bank might incur a loss. So if the bank will incur a loss, how much is the minimum amount of capital that they should maintain? Capital means their own money. How much is the minimum amount of capital they should maintain which will help them absorb these losses? That is called as capital adequacy ratio. Right? The Basel guidelines mandate that the capital adequacy ratio has to be 8%. The Basel guidelines mandate that the capital adequacy ratio has to be 8%. But please understand, Reserve Bank of India, which is the banking regulator, is it okay? Reserve Bank of India, which is the banking regulator in India, the RBI mandates that it should not be 8%, rather it should be 9%. In case of RBI, it has changed this number. It is not 8%, it is 9%. But is the number 9% universally applicable to all the banks? Again, RBI simply says, no. I'll keep on changing this number according to the requirement. Requirement in the sense, if you're a payment bank, it will be much greater, 15%. If you're a public sector bank, it will be 12%. If you're a scheduled commercial bank, it will be 9%. Done? So Basel I guideline focus was on capital adequacy ratio because the banks might incur losses because of the risk-weighted assets. Now, after Basel I guideline, the Basel Committee brought in one more round of regulations. That is Basel II. Basel II guidelines. In the Basel II guidelines, rather than focusing on only one risk, now the focus was on 3 types of risk. Is the point clear? Rather than focusing only on the one risk, now the focus was on 3 types of risk. What are the 3 types of risk? One essentially is the credit risk, that is give a loan. What if the borrower doesn't repay? Credit risk. In addition to credit risk, there will be operational risk. The risk that is arising because of the systems, processes, etc. I can give you a best example from the current affairs. All of you heard of what has happened in the IDFC First Bank? Please do let me know in the chat section. IDFC First Bank. All of you have heard? Right? So because of the systems, because of the process, because of the people, the bank might incur a loss because of that. And that is basically called as an operational or systemic risk. And there will be one more type of risk, that is basically the market risk, right? Because of your investments in the market. What if the investments in assets that you have done, if the value of the assets drop down, right? So I hope you understand. There will also be this type of a risk, right? So multiple types of risk were identified. They were categorized into 3 types under Basel III. Now to overcome the risk, to basically minimize the risk, minimize the losses, etc. Now under Basel II, there was a 3-pillar approach. A 3-pillar approach. What is a 3-pillar approach? The pillar 1 essentially is a capital adequacy ratio, CAR, capital adequacy ratio. Maintain certain amount of a capital, your own capital to absorb loss, capital adequacy ratio. Second one is market discipline, and the third one, supervisory review. Supervisory review. Right? What is this idea of a market discipline and supervisory review? Essentially, you know that you are going to face a certain amount of a risk. You have a risk, you are going to face risk. Now, why don't you implement certain policies? Why don't you take certain measures, take certain steps in order to minimize the risk? Is everybody okay? You know there is a risk. You have already identified 3 types of risk. Then why don't you take certain measures to minimize the risk, reduce the risk? And that is essentially the market, the market discipline. Then there's a supervisory review, right? Whatever you do, right? Whatever policies you implement, right? Whatever steps you take, all of this you will have to disclose it to the central banker. All of these you will have to disclose it to the central banker. So these are essentially referred to as a 3-pillar approach. Is everybody okay? Please do let me know. I know slightly technical, but you should be aware of all of this. You should be aware of all of this. 1, maintain own capital to absorb loss. Second one, you know that there is a risk, you know there could be a loss, then take certain steps, take certain measures to minimize the risk. And the third one, whatever reforms you implement, whatever measures you take, are you maintaining the capital adequacy or not? How are you maintaining the capital adequacy, etc.? Disclose all of this information to the central banker. These are the 3 pillars. This is called as a 3-pillar approach. This is Basel II. We have implemented this. We are now basically implementing Basel III guidelines. Right? We are implementing Basel III guidelines. What are the important points under the Basel III guidelines? First one, as usual, capital adequacy ratio. Capital adequacy ratio. But please listen to me very carefully now. Compared to Basel II, within the capital adequacy ratio, now there is a mandate that you should maintain more of tier 1 capital. Is my statement clear to all of you? Now there is a mandate under the Basel III that you are supposed to maintain more and more of tier 1 capital. What is this idea of a tier 1 capital? Your own capital, that is bank's own capital, is basically the total capital. Now the total capital is divided into two parts. And why should you keep your capital? In order to absorb losses. That is what the Basel guideline says. So whatever total capital you are maintaining is divided into two types, tier 1 and tier 2. Out of both of these types of capital, tier 1 is more reliable. Tier 1 can absorb the losses much more easily. And that is the precise reason the Basel guidelines mandate that you should maintain more and more of tier 1 compared to tier 2 capital. Is it okay? Right. So under the guidelines now, right, under Basel III, capital adequacy ratio, you are supposed to maintain more of tier 1 capital. Second one, capital conservation buffer. Right, again, part of common equity tier, or basically in the form of common equity tier, the capital conservation buffer. What is this idea of a capital conservation buffer? The capital conservation buffer essentially means additional capital. Buffer means extra, additional capital. You should maintain certain additional capital so that you can absorb the losses when there is emergency. Is everybody able to understand? There will be emergencies, and when there are emergencies, the losses, right? And when I say emergency, let's say there is a recession. Hypothetically, let's say there is a recession. When there is a recession, don't you think, right, the losses that could be incurred by the banks will become much higher? So in such situations, in that kind of a situation, the banks must be able to absorb more losses, and that can happen only if you have maintained more additional capital. That is basically the concept of buffer here. Capital conservation buffer. How much is the capital conservation buffer? 2.5%. 2.5% of risk-weighted assets. In addition to this, there is also liquidity coverage ratio, LCR. Liquidity coverage ratio. What is this idea of a liquidity coverage ratio? At any given point of time, the bank has to estimate, I repeat, at any given point of time, the bank has to estimate how much will be the money outflow in the next 30 days. How much will be the total money outflow from the bank in the next 30 days. Estimate that number and maintain the high quality liquid assets, HQLA, high quality liquid assets equivalent to 100% of your estimate. Sir, what is the meaning? Right? A lot of you will simply say, what is the meaning of the statement? Let's assume I'm operating a bank. According to my estimates, in the next 30 days, the total money that will be flowing out of my bank will be 50 crore rupees. Now, liquidity coverage ratio simply says, I will have to maintain high quality liquid assets of at least 50 crore rupees. So that if at all, there is a sudden requirement, if there is a sudden outflow of money, I should be able to have these high quality liquid assets, right? Convert them if it is government security, because the HQLA can be in the form of a cash, can be in the form of a bond, etc. So if at all there is a sudden outflow of money, I don't have to be worried. I will have these liquid assets. I can convert them into cash. If it is not in the form of cash, allow the funds to flow out of the bank. Is everybody okay? Please do let me know. That is basically the idea of a liquidity coverage ratio. Done. So these are certain sets of guidelines, which is basically referred to as Basel guidelines. Right. So these are the important concepts within the idea of a banking. Now, in addition to this, there is also one more idea, the NBFC, non-banking financial companies. NBFC, non-banking financial companies. Right. First and foremost, what is an NBFC? It is an institution. It is a financial institution which will provide services similar to a bank. I repeat, services similar to a bank, but without having a bank license. It is an institution which will provide services similar to a bank, but without having a banking license. For example, all of you heard of, right? Let's say the services, right, wherein certain institutions will provide you gold loans. Please do let me know. They will provide you the services of gold loans. They will provide you loans to purchase car. They will provide you the services where you can take a loan and purchase a house, where a company can take a loan, develop infrastructure, etc. So understand the logic here. These are financial institutions. They will provide the services which are similar to a bank, but they do not have a banking license. These are called as non-banking financial companies. And when I say non-banking financial companies, there itself you'll understand these are registered under the Companies Act. Is it okay? These are registered under the Companies Act. And these particular NBFCs generally are classified into the deposit taking NBFCs as well as non-deposit taking NBFCs. But fundamentally, how different are they compared to a bank? Fundamentally, how different are they compared to a bank? Because they will provide similar services. Banks will collect deposits. NBFCs, right, are also allowed to collect deposits. They are also allowed to collect deposits. But please understand, the banks can collect deposits either in the form of a savings bank account as well as, right, let's say time deposit. That is the demand deposit as well as the time deposit. Savings bank account is a type of a demand deposit. Okay. So they can collect the deposits in the form of a time as well as a demand. But NBFCs are not allowed to collect demand deposits. They are only allowed to collect, I repeat, they are only allowed to collect time deposits. And that too, unlike a bank, they are not allowed to collect any type of a time deposit, only those time deposits which are between 12 months to 60 months. 12 to 60. Right? So banks can issue checks. If you open a bank account, they will give you a check. Whereas NBFCs don't give you a check. They can't issue checks on their own name. That is basically because banks are part of a payment and settlement system. NBFCs are not part of a payment and settlement system. Please remember, NBFCs are not part of payment and settlement system. So what do you mean by that? If you want to transfer funds, for example, you want to make RTGS, you want to make an NEFT transfer, you can you can transfer the funds, go to a bank, transfer. But if you go to an NBFC, they will not provide you services because they are not part of the payment and settlement system. Simple idea. Right? So this is essentially, and moreover, one more very important fundamental difference between both of them. When you keep deposits in a bank, there is an insurance. There is an insurance. Whereas when you keep the deposits, right, in a, let's say, a deposit taking NBFC, there is absolutely no insurance. There is absolutely no insurance there. DICGC does not cover the deposits with an NBFC. Then everybody is okay with the distinction and difference between both a bank as well as an NBFC? NBFCs, please understand, in the context of NBFCs, you will have to take the certificate of registration from Reserve Bank of India. But if you are, let's say, a stockbroker, if you are a mutual fund, which is an NBFC by the way, regulator is SEBI. If you are an insurance company, regulator is IRDAI. If you're a pension company, then there is one more regulatory authority, PFRDA. Right? So there are different regulatory authorities, but if you're deposit taking NBFC, generally you come under RBI. Done? Everybody is okay? So this is basically the discussion I wanted to have in the context of, right, the banking sector. Can I move on to the next chapter now? Do let me know. Those present, do let me know. Can I move on to the next chapter? And before I go on to the next chapter, please do let me know if there are any doubts or confusion regarding whatever we have discussed so far. Any doubts or confusion? Sir, but time deposits collected by NBFC only? My dear, NBFC are allowed to collect time deposits. I'm saying NBFCs are allowed to collect time deposits. NBFCs are not allowed to collect demand deposits. Right? Bank is allowed to collect demand as well as time. Okay. Payment banks can't take fixed deposit. My dear, payment banks have a different system. Don't worry about all of it. Okay, their kind of deposits, yes, they can take different types of deposits. Okay, done. CAR of risk weighted assets or NDTL? My dear, CAR is for risk weighted assets. CAR is a risk weighted asset. It is for risk weighted assets. That is basically hypothetically. Imagine, I'm taking a simple example to explain it. Loans. A bank has given a loan. It is risky. So a loan is given certain risk weightage. How much of the loan is risky? That is called as risk weighted asset. Difference between AT1 and Tier 2. AT1 bonds are basically perpetual bonds. AT1 bonds are basically part or the money that is raised by the banks, it is counted as a part of Tier 1 capital. Tier 2 bonds will have a maturity period. When the bank issues, there is a maturity period for it. Right? These are counted as a part of Tier 2 capital. And between Tier 1 and Tier 2, first the loss absorption is done by Tier 1 and then loss absorption is done by Tier 2. Okay, let's go forward. Next, I want to discuss is the financial market. Next topic, financial market. Okay, so financial market, let's start now. Please have a look at the picture. The financial market is divided into two parts. One is the money market, second one is the capital market. What is essentially the difference between the money market and the capital market? If a company wants to raise funds for a very short duration means what? Up to 1 year. Up to 1 year. If the company wants to raise funds for a very short duration, that is up to 1 year, they go to money market. And why do the company wants to raise money for a short term? Because they want funds for taking care of working capital. Simple, everybody is okay. They want to take care of working capital requirement. That is essentially take care of the day-to-day operation. Whereas, if the company wants to raise money for investment purposes, that is, let's say, setting up of a new manufacturing facility, setting up of, let's say, a new service sector unit, or acquisition of machines, etc. In such cases, the company doesn't generally go for money market. It goes to one more market, which is called as a capital market. Right, capital market is used by the borrowers or the companies, not borrowers, because borrowers are a part of capital market. So companies or anybody who wants to raise the funds for a longer duration, that is more than 1 year, they will go to capital market. Is everybody okay with the difference between money market and capital market? Do let me know right now. For example, let me ask you a very simple question. Where do you think repo and reverse repo will come? Don't look at the chart and tell the answer. You think of it and do let me know. Where do you think, according to you, the repo and the reverse repo should fall? Right? Is the idea very clear? Because repo and reverse repo, it's not a long-term instrument. Repo and reverse repo is a short-term instrument. Short-term means up to 1 year. It has to come under money market. Is it okay? It has to fall under money market. Everybody is okay? Right? So, on one side, we have a market where the funds can be raised for a very short duration. And we also have a market where the funds can be raised for a very long duration. Up to 1 year, more than 1 year, for working capital purposes, for investment, asset creation purposes. That is a very important distinction between money market and capital market. Now, let's focus on money market instruments. Let's focus on money market instruments. We have call money market, we have treasury bills, certificate of deposit, commercial bills, commercial papers, repo and reverse repo. Repo and reverse repo. Let me start with the last one, repo and reverse repo. What do you mean by repo? RBI will give a short-term loan to a bank, charge a rate of interest. Is the point clear? RBI will give a short-term loan to a bank and charge a rate of interest. That is repo. Reverse repo. RBI will borrow from a bank for short duration and pay a rate of interest. Simple. Everybody is okay? Repo and reverse repo. It's a revision because I've already covered this when I discussed the functions of Reserve Bank of India under monetary policy or credit control tools. Is everybody okay? Please do let me know. Repo and reverse repo. Now, let's go forward. Let's go forward. Call money market. What is the basic idea of a call money market? Under call money market, one bank will give a loan to another bank. Under the call money market, one bank will lend to another bank. And this lending is for very short duration. Sir, what do you mean by very short duration? It could be done for 1 day. Very short duration. It is done for 1 day. It is done for 7 days. It is done for 14 days as well. But please understand, when it is done for overnight purposes, overnight means 1 day, it is called as a call money. And when it is done for 7 days, 14 days like this, it is called as notice money. Is the point clear? When it is done for overnight purposes, call money. When it is done for more than 1 day, it is called as a notice money. And why is it done? Simple. There are different banks in the system. One bank will have lot of liquidity and another bank is having shortage of liquidity. Are you able to understand? One bank, imagine there is one bank where lot of depositors have kept money today. People have deposited money. There is one more bank from where people have withdrawn money. And that is very common. It's a very common occurrence, by the way. So here are two banks. One has more liquidity and the other one has a shortage of liquidity. So one bank will lend to another bank. This is called as basically the call money. And there is a rate of interest charged on this, and that rate of interest is called as call money rate. And that call money rate is very dynamic in nature. I hope you understand the call money rate is dynamic. Dynamic in the sense, the rate of interest under the call money market is determined based on supply and demand. It is determined based on supply and demand. For example, what if there is a huge liquidity deficit in the market? Think of it. There is a huge liquidity deficit. That is, the banks have lot of shortage. Banks are finding it very difficult to collect deposits. Now they will borrow more from surplus banks. Right? Obviously, in that particular case, the demand for the money in the call money market will be higher, and that will essentially lead to increase in the call money rate as well. So please remember, it's very dynamic. There is no single rate like this. It is very dynamic or fluctuating like this. Is everybody okay with the call money market? Simple. Interbank lending and borrowing. Call money market is nothing but interbank lending and borrowing for short duration. Next, treasury bills. Treasury bills. What are treasury bills? These are essentially the government securities which are issued by the central government. I repeat, issued by the central government to borrow for a duration up to 1 year. That is, maximum duration of a treasury bill is 364 days. We have 91-day treasury bill. We have 182-day treasury bill. We have 364 days of treasury bill. But the idea is very simple here. These are instruments used by the center because the states are not allowed to issue treasury bills. Please remember that. States are not allowed to issue treasury bills. Only the center is allowed to issue treasury bills. So center issues the treasury bills, 91 day, 182, 364 borrows from the market. Everybody is okay? It is also one part of money market. Next one, certificate of deposit. Certificate of deposit. What is this idea of a certificate of deposit? Let's start. Certificate of deposit. You keep a fixed deposit in a bank. Correct? You keep fixed deposit in a bank. Now this particular bank will keep the money for certain time period. It could be 1 year. It could be 3 years. It could be 555 days. And upon maturity, they will return the principal to you. And based on your choice, I hope you understand, based on your choice, the interest will also be paid to you by the bank. But one of the very important features of a fixed deposit is, if you are the owner of a fixed deposit, you cannot transfer it to anybody. You cannot sell it to anybody in the market. But please understand, various financial institutions are allowed to issue a type of an instrument to borrow for a short duration, generally 3 months, 6 months like this. For a short duration, they can borrow from the market, and that is called as a certificate of deposit. And what is essentially the feature of a certificate of deposit? Imagine you have invested, purchased a certificate of deposit. Can you transfer it to somebody in the market? Yes, these are transferable in nature. Is everybody okay? These are transferable in nature. You can transfer these particular instruments to others in the market. Right? So the financial institutions, for example, lot of these all India financial institutions, lot of these AIFIs traditionally use this particular route if they want to borrow for a shorter duration. Is everybody okay? Please do let me know. Right, those present in the session, please do let me know. Is the concept clear to all of you? Please participate and tell me. I don't want you people to simply sit, listen and go home. No. I want you people to participate and tell me whether you're able to understand or not. Okay, great. Let's go forward. Right? So certificate of deposit. Okay, let's go forward. Commercial bills. Because I've seen students, basically they come, they sit, right? They will keep on doing something else while I'm discussing. And later they'll say, sir, this is right doubt, that is doubt, this is right not clear, etc. I want you people to participate. I want you to answer to my questions whenever I ask you. Right? Okay. So commercial bills. What is the idea of a commercial bill? Right? What is this concept of a commercial bill? Right? So why 364, not 365? My dear, please understand, any instrument which is below 1 year, because if you say 365 days, it becomes 1 year, right? You want to keep it below 1 year. And if you see that, generally the concept of all of these instruments, especially the government, let's say the treasury bills, essentially, will you not see this in terms of, let's say, 7 days, right? In terms of weeks, in terms of, right, let's say number of weeks, in terms of number of months like this, right? So, for example, they'll say up to 28 days, up to 14 days, up to 7 days, up to 91 days. If you just look at it, it is always in the multiples of weeks like this. So, if you hit 365, it will become 1 year. It cannot be less than 1 year. It will become 1 year. So that's the reason the maximum duration that is given is 364. Okay, anyways. So commercial bills. What is the basic idea of a commercial bill? In case of a commercial bill, a seller and a buyer. Please understand. There are two parties. Okay. Seller and a buyer. Let's imagine I'm a seller. You're a buyer of my product in the market. I will sell this to you, but the value of this amount, or value of this particular product, let's say 5 lakh rupees. You are not going to make a payment of 5 lakh rupees immediately to me. Right? You will not make the payment of 5 lakh rupees immediately to me. Why? In the business, there is always a concept of a credit cycle. Correct? All of you heard of this? There is always a concept of a credit cycle in the business. So what you basically say is, you will make the payment, but after 45 days. But for 45 days, what you will do is, you will basically issue an instrument to me, and that is called as a commercial bill. Is the point clear? That there are different names for this, but most famous name is basically the commercial bill or trade bill, bill of exchange, etc. Argument is simple. Because you are buying the product, you are not saying that you will not make the payment, but you are also arguing that you will have to produce a good and sell it to somebody else. Until you sell it, you don't have money. So you are telling me you will make the payment. You will purchase the goods today, you will make the payment, but not today, after 45 days. So till 45 days, what should I do then? I should have certain instrument in my hand which will prove that you owe payment to me, and that is basically the commercial bill. Is everybody okay with the idea of a commercial bill? Sir, what is the use? If I have that particular piece of paper, what is the use? Let's say you have issued this particular bill today. I will receive the payment after 45 days. But after 30 days, I need money. After 25 days, I need money. In such cases, I can simply trade these particular commercial bills in the market, get the money. For example, please do let me know now. Let me see how many of you are reading current affairs. All of you have come across TReDS in the current affairs? Do let me know. All of you have come across TReDS in the current affairs. This was there in the budget announcement as well. What was the announcement in the budget? The finance minister stated that all the CPSEs, central public sector enterprises, whenever they procure from the MSME, now this has to happen on the TReDS platform. Simple. It has to happen. That is, the bills receivable has to be generated. Not the buying. The bills receivable has to be generated in the TReDS platform. And what is the use of a TReDS platform? There are multiple financiers on the TReDS platform. I will receive the bill, that is called as a bills receivable. You will give the bills receivable to me. After 25 days, I can sell it to a financier, get the money from the financier. And that is basically the benefit of having this kind of a system. Is everybody okay? Please do let me know. I'm throwing current affairs also so that you understand what is the importance of all of these instruments. Okay. So commercial bills. And I hope you understand. The commercial bills are also of a very short duration. These are not very long duration. Nobody will buy the product and promise a payment after 10 years to you. Nobody will purchase the raw material today from you and guarantee a payment after 15 years. It is generally a very short duration according to the MSME Act. If you purchase from the MSMEs, you will have to make a payment in 45 days. Under MSME, you will have to make a payment in 45 days. There is no other option for you. Okay, right? So commercial papers. Commercial bills. Let's go forward now. Commercial paper. Commercial paper. Now the commercial papers essentially are the short-term instruments which are issued by the companies. Companies, mind you, right? Essentially, these are the companies which require certain working capital. They have a shortage of working capital. So rather than borrowing from a bank where they might simply say it is too costly for them, rather than taking a loan in the market, etc., what these companies do is they will issue short-term instruments. These are called as commercial papers. Issue the instrument, take the money from the borrower, and after the maturity period is over, return the money. So this is essentially the concept of commercial papers. And before I go forward and start discussing other instruments in the market, please understand a lot of the instruments that I've discussed right now under the money market, these are negotiable instruments. These are negotiable instruments. And what do you mean by negotiable instruments? Whenever you can transfer the instruments to somebody else, these are called as negotiable. Is my statement clear to all of you? When you can transfer the instruments to somebody else in the market, these instruments are referred to as negotiable. Is everybody okay? And a lot of these instruments also follow the concept of zero coupon. A lot of these instruments also follow the concept of zero coupon. For example, treasury bills. For example, treasury bills, certificates of deposits, etc. These are zero coupon instruments. What do you mean by zero coupon? These instruments are issued at discount. These instruments are issued at a discount. And upon maturity, the face value is provided. Upon maturity, the face value is provided. Is everybody okay? Please do let me know. These are issued at discount, and upon maturity, the face value is provided to the investor. That is basically, let's imagine there is a bond. The bond has a face value of 100 rupees. When I will sell it to you, I will not sell it to you at 100 rupees. I will sell it to at, let's say, 60. I will sell it to at 50. I will sell it to at, let's say, 70. And upon maturity, and again, I know I'm talking about a bond here. Please don't get confused. I know I'm talking about a bond. Bond by default has a maturity period of more than 1 year. Bonds, maturity period is more than 1 year. And I'm discussing about money market also, but listen to me carefully. In case of a bond, face value is 100. Let's imagine the maturity period of the bond is 3 years. I will sell it to you at 50 rupees, and after 3 years, I will give 100 rupees to you. That will happen in the context of a bond because the maturity period is greater. Whereas in case of, let's say, treasury bills will have a maturity period of 91 days. They will have a maturity period of 182 days, etc. In such cases, I will not give it at a deep discount like this. Maybe, let's say, 100 rupee face value, I will sell it to you at 95 rupees. Is it okay? I will sell it to you at 95 rupees. And after 182 days are over, I will give you 100 rupees. Right? That is upon maturity, I will give the face value to you. So understand the logic here. The concept of a zero coupon is a very neutral idea. Neutral in the sense there can be long-term instruments which can be having zero coupon idea. And they can be short-term instruments also which will follow the idea of a zero coupon. But the model is very simple. When you are issuing the instrument, you are issuing them at a discounted price. And upon maturity, you will give the face value. Is everybody okay? Right? And again, please understand, is it applicable to all the instruments in the money market? No. Just apply basic common sense, you'll understand. For example, call money. Do you think in call money there is a buying and selling of an instrument? No. Correct. In call money, there is no buying and selling of instrument. Right? Or a trade bill or the commercial bill. This is basically the idea where the trade receivables are issued in the form of an instrument. But other types of instruments, generally these, right, are following the idea of a zero coupon instrument. Okay, everybody is okay with the money market now? Can I move on to the next one? Do let me know. Those present in the session, do let me know. Can I move on to the next one now? And I know a lot of you will be thinking, sir, break. 1 hour 20 minutes are over. Within 1 hour 20 minutes, already there have been 3 micro breaks. 3 micro breaks. Right, sir, what were those 3 micro breaks? There was some disruption in the camera. I was fixing the camera and somebody was saying, sir is floating. Because there was some disruption in the technology and basically that camera, the alignment got changed. And somebody was commenting, sir is floating, see. Right, so somebody was saying, sir, 2 minutes break here only. Okay, let's go forward. Right, don't worry, I'll give you break. Let's cover important concepts. I'll give you break, don't worry. Okay, so these are certain important points in the context of money market. Now, before I go forward to the capital market, please understand, in the idea of money market, suddenly there are some types of old instruments. Old instruments are thrown at you, right? Some old instruments, questions are asked in the prelims examination. For example, some time ago, there was a question asked on one instrument called as CBLO. Collateralized borrowing and lending obligations. CBLO. It is not used today. It's an old instrument, part of money market, but it was used earlier because we don't use CBLO now. This has been replaced with one more system called as TReDS. Right? That is tri-party repos. Right? What is a CBLO? Because you never know what UPSC will do. They will ask you these kind of outdated concepts as well. They might ask you these kind of outdated concepts as well. What is basically the idea of a collateralized borrowing and lending obligation? Under the CBLO, there are 2 institutions which will essentially use instruments such as government securities. Simple, right? And again, I'm saying this is not used now. This was used earlier. Under CBLO, there are 2 financial institutions which will use bonds or debt instruments such as government bonds to lend and borrow. Simple. To lend and borrow. For example, let's say there is one mutual fund company, or let's say one insurance company, or one bank, one NBFC, etc. They will give loan to somebody else, and in return they will collect a security that is a government bond. Right? That is the reason it is called as collateralized. Look at the term, look at the expansion of this. C means what? Collateralized. Collateralized borrowing and lending obligations, which means you have given a loan, but you have collected a collateral. You have collected a collateral. Now, are we using the CBLO? No, we are not using CBLO. Rather, using CBLO, we have shifted to one more concept called as a TReDS. Right? Tri-party repo. TReDS stands for tri-party repo. What is this idea for tri-party repo? Simple. There is one organization, or let's say one financial institution. There is another financial institution. Between both of them, there is a third party. Is it okay? There is a third party. Sir, what is the use of the third party? There has to be one institution which will mediate between both of these financial institutions, which will help lending to happen, which will help, right, collection of the security, that is collection of the asset, which will ensure the transaction is settled. Simple, right? Which will ensure that the transaction is settled. For example, right, there is a Clearing Corporation of India Limited, CCIL, generally promoted by it. Clearing Corporation of India Limited. What does it do? It will basically promote lending of one institution to another, correct? But it will ensure that assets are collected. It will keep the asset, and after the time period is over, it will ensure the settlement of the transaction is done. Now, because there are three parties involved, I repeat, because there are three parties involved, this is called as a tri-party repo or TReDS. Is it okay? My dear, I'm telling you the real example only. Any real example? This is very, very common activity that happens on day-to-day basis in the money market. There are two institutions. One will lend to another institute, but there is a third party involved because there is a security. Collateral has to be provided. The clearing corporation will collect the collateral, and upon maturity, they will ensure that the collateral is returned, money is repaid, interest is paid, etc. Because there are three parties involved, it is called as a tri-party repo, in short, TReDS. Done? Everybody is okay? Please do let me know. So these are certain important points regarding the concept of a money market. And just to make it easier, whatever I've discussed so far, just to make it easier, all of it has been put in a form of a table here. Please download the PPT or the PDF after the session is over. It will be uploaded, download it, and use it for revision purposes. Call money market, what does it actually mean? Treasury bills, right? The certificate of deposit, the commercial paper, commercial bills, right? Different instruments which I've discussed, they have been given. What is the meaning? What is the inference, etc. It has been provided in the table. Download and revise, right? Download, but more importantly, revise. Please revise. And do not worry about the notes. I can see a lot of you are worried about the notes. I don't know how many of you have attended my first marathon session. After the marathon session, I gave you the handouts. I think the length of the notes, that the number of pages, hardly around 20 pages. Even after today's session, I will give you notes. Have patience. Tomorrow, right, sit in the morning, download the notes and simply revise using the notes. I think the second set of notes will also be hardly around 15 to 18 pages. That is serial number 15 to 18, which means if you take a printout, it will hardly become 9 pages. Right? So please don't worry about the notes. Focus on the discussion. Now, money market is over. Let me shift to the capital market. Let me shift to the other important market, that is capital market. Now, what are the important points in the capital market? First and foremost, capital market is used by the entities to borrow for longer duration, to raise money for longer duration. And I'm using two terms here, borrow and raise. Borrow means you're simply using an instrument to borrow and repay. Raise means you may not have the liability of repayment. I'll discuss that in a minute, don't worry. So the companies essentially will use this particular route if they want to create assets. It will contribute to capital formation, etc. Now the capital market, essentially the instruments used in the capital market are one, the debt market, right? Basically instrument is debt instrument, hence called as a debt market, and the second one is equity market. Debt market and equity market. What is the meaning of the term debt market and equity market? Let's take a very simple example. Imagine here is a company. Okay, imagine here is a company. Now this particular company wants to start a new manufacturing facility. Okay, they want to start a new manufacturing facility. Now to develop this particular new manufacturing facility, one way is they will issue instruments, for example, bonds. They will issue instruments, bonds, borrow from the market, use the money to set up the manufacturing facility. Possible? Please do let me know. Understandable? They will issue bonds to you, let's say 15-year bond, 20-year bond, right? Or 7-year bond. They will borrow money from you and they will use this money to set up the new manufacturing facility. Or else, they will essentially sell the shares. Shares basically represent ownership. Please remember, shares means what? The shares represent ownership. Shares are nothing but units of ownership. Units of ownership. So essentially, they can now go to the market, sell the ownership, collect the money, and use the money for setting up a new manufacturing facility. Is everybody okay with the two examples that I've given? Do let me know. Anybody still has a confusion? Anybody has a doubt regarding this? Right? So one way is issue a bond, sell a bond, collect the money and invest. But please understand, bond is nothing but a debt instrument. What is a bond? Bond is nothing but a debt instrument. That is basically you're borrowing and you're promising repayment. You're promising a repayment. Right? So when you issue this, that particular market is called as a debt market. You issue these instruments in the debt market. But if you want to sell the ownership, company wants to sell the ownership, raise money and use the money to set up a new manufacturing facility, that is basically equity, right? And that is equity market. So you can collect the money, but in one case, there is a repayment liability. In the second case, there is no repayment liability. That is in case of shares. If you purchase the shares of a company, the company doesn't have any liability to repay money to you because now you are part owner of the company. Simple, you are part owner of the company. Whereas if you purchase a bond of a company, the bond amount has to be repaid. Annually, coupon has to be paid if there is a coupon rate on it, etc. So one is called as a debt market, second one is called as equity market. Can we go forward now? Can we enter into the debt market and look at the important instruments, different types of debt, etc., or different types of bonds? Different types of bonds. Now, what are the different types of bonds? Let's go one by one. One is called as a convertible bond. One is called as a convertible bond. What do you mean by convertible bond? The company issues a bond. After certain time period, you have an option to convert the bond into a share. Simple. Is it okay? Do let me know. I'll repeat it again. The company has issued a bond. But after certain time period, maybe 2 year, maybe 3 year, etc. After certain time period, you have an option to convert this bond into a share. This is called as a convertible bond. Second, non-convertible bond. Non-convertible bond. What do you mean by non-convertible bond? The company will issue the bond to you. It will be issued as a bond. It will mature as a bond. Today I will issue this as a bond to you and I'll simply say after 7 years, maturity period will be over. Issued as a bond, matures as a bond. right? You are not allowed to convert this into any other form of a instrument. This is called as non-convertible bonds. So example, my dear, tell me government bonds. Please tell me now, government bonds. Anybody will simply say government bonds are convertible in nature? Does Government of India issue a bond to you wherein there is an option that after 3 years you can convert this into ownership in the government? Right? You will get ownership in the Government of India. No. Right? I hope you understand. These are issued as a bond. They will mature as a bond. Then somebody will say, in that case, give me example of convertible bonds. I'll give you one example. Lot of Indian companies in the past, they have done this. They have been allowed to issue a type of bond called as foreign currency bonds. Foreign currency convertible bonds. Okay, foreign currency convertible bonds. And these in short were referred to as FCCBs, foreign currency convertible bonds, wherein the companies have gone to the external market, issued bonds with a promise that if the investor wants, if the investor, that is the holder wants, after a certain time period, that bond will be converted into share of the company. Simple, that will be converted into the share of the company. These are called as foreign currency convertible bonds. Is everybody okay with this? Right? Is everybody okay? So convertible, non-convertible. Third one, indexed bonds. Third one is indexed bond. What do you mean by indexed bond? Earlier, the Government of India had issued, underline the term had. Earlier, the Government of India had issued a bond wherein the Government of India basically issued the bonds and guaranteed the payment where the returns were connected to inflation rate. Where the returns were connected to inflation rate. What is the meaning of it? The government will announce a coupon rate to you, but the government is saying that if the inflation rate changes, then your coupon rate will also be automatically adjusted. All of you are able to understand the meaning of indexed? Index means adjusted. Indexed means adjusted. Is everybody okay? Do let me know right now. So when the government issues these kind of bonds or corporate sector issues these kind of bonds, they will basically say, they will give you a confirmation. This adjustment will be done with what parameter? Will it be done with a WPI? Will it be done with a CPI? Will it be done with the IIP? Right? Whatever the parameter is, don't worry. But the argument is simple. The principal amount, the coupon rate, etc. are connected, are adjusted to a parameter. These are called as indexed bonds. Is everybody okay? These are referred to as indexed bonds. And lot of investors would want to invest in these kind of bonds, by the way, because listen to me carefully. A traditional bond does not provide any guarantee against inflation. Is everybody able to understand? I'll repeat it again. A traditional bond does not guarantee protection against inflation to you. If you have invested in a bond, imagine, and the coupon rate is let's say 5% or let's say 7%. If there is an inflation of 6%, then your returns will be eaten away by inflation rate. Whereas, if there is a bond which is inflation indexed, in such case, whatever is the impact of inflation now, your returns are automatically adjusted. Your returns will be automatically adjusted. And that's the reason in the market, many of the investors would be interested in investing in these kind of bonds. Right? So, indexed bonds. Is everybody okay with this? Do let me know. Is everybody okay? Now, fourth one, right? The zero coupon bond. Fourth one, zero coupon bond. We have discussed the concept of a zero coupon bond hardly around 10 minutes ago. Hardly around 10 minutes ago. And I know for a lot of you, it would have felt 1 hour. I know you'd have felt, let's say it was discussed 1 hour ago. No, it was discussed hardly around 10 minutes ago. What is the basic idea of a zero coupon? These are issued at a discount and upon maturity, you will get the face value. And why these are called as a zero coupon? Because there is no discussion, there is no coupon rate on the face value calculated. Is it okay? On the face value, there is no calculation of coupon rate. Because whenever a bond is issued, coupon rate is told to you, coupon rate is guaranteed to you. In this case, there is no coupon rate calculation. That is the reason this is called as a zero coupon bond. Is everybody okay? Zero coupon bond? Okay. In addition to this, right, these are traditional types of bonds. In addition to this, are there any other types of bonds? For example, green bond. Green bond. And I know some of you will be thinking, sir, 540, right? Brook bond chai ho jai. That's a different type of a bond, by the way, not associated with economics, right? So green bond. What is the idea of a green bond? Green bond are debt instruments. Simple, these are debt instruments which can be issued by government. Can the government issue green bonds? Of course, yes. They are called as sovereign green bonds. These can be issued by the private sector. These can be issued by government-owned entities. These, in fact, can be issued even by, right, let's say banks. Again, these are companies only. By the banks, even by the global organizations. That is global the global financial institutions. For example, World Bank. So these, right, basically issue certain instruments. But why are these called as a green bond? Any specific reason why these are referred to as a green bond? These are referred to as green bonds because whatever funds are raised, whatever funds are borrowed by issuing this kind of an instrument, this is used only for investment in environment-friendly projects. In environment-friendly projects, right? Sustainable projects. For example, wind energy projects. For example, clean drinking water, sanitation, right? Or for that matter, let's say solar energy projects, etc. Right? So these are basically called as green bonds. Is everybody okay? Please do let me know. Right? Recently, Bank of Baroda borrowed green bond. Yes, my dear. In today's newspaper also it was there. Right? Earlier newspaper also it was there. And by the way, how many of you heard of NSE International Exchange? NSE International Exchange. NSE IX. There was a bond that is basically blue bond. Right? This is there in the newspaper, by the way, now. Blue bond. Sri Lanka's first blue bond. I repeat, Sri Lanka's first blue bond has been duly listed in the NSE International Exchange. And I know somebody will be thinking, what is this international exchange? I only have heard of Bombay Stock Exchange. I only have heard of National Stock Exchange. What is this international stock exchange? I'll discuss that when I take up the model of special economic zone. Right? Because there is a model of a special economic zone specifically for promoting financial transactions. That is GIFT IFSC. GIFT IFSC, I'll discuss that there. Don't worry. So blue bonds, again, please understand, blue bonds are also type of green bonds only. Simple. Right? The blue bonds are also type of, right, green bonds only. But it is more associated with the projects where there is a focus on conservation, right, in the sea. Focused on water projects, focused on sea-related projects. That is the reason these are called as blue bonds. Done? Everybody is okay? Green bond. Now, sixth one, masala bond, your favorite? Masala bond. What is the specialty of a masala bond? Simple. In masala bond, the entities are allowed to issue the bonds which are denominated in rupees. Is everybody okay? Masala bonds are essentially the bonds. These are debt instruments only. But in this case, the denomination of the bond, that is the value of the bond, is given in rupees. These are issued in the outside market, overseas market. In this case, the issuance is denominated in rupees. The repayment is denominated in rupees. Which means, listen to me carefully. Rather than me issuing a bond, borrowing dollars, repaying in dollar, if there is any fluctuation in the exchange rate, it will hurt me. Correct? It will hurt me because let's say when I borrowed exchange rate was $1 is equal to 70 rupees. And now I'm about to repay because of what is happening in West Asia, etc. $1 has become is equal to 92 rupees. So there is a repayment pressure on me whenever there is an adverse movement in the exchange rate. So in order to protect myself, can I use one more type of an instrument where I can borrow from external market, but there is no risk on my shoulders. There is no impact of exchange rate volatility on my repayment. And that is basically masala bond. That is basically masala bond. Right? The bonds are issued which are rupee denominated. And upon the maturity period getting over, I will again repay in the form of, right, let's say rupees only, which means the risk is associated with investor, not the borrower. The borrower doesn't take a risk, investor takes the risk. Is everybody okay with the discussion? Please do let me know. Everybody is okay, right? Let me cover one more concept, then we can take a break. Okay, seventh type of a bond. Seventh type of a bond, that is sovereign green bond. Sovereign green bond. This was also there in the newspaper, by the way. Sorry, sovereign gold bond, not green bond, because green bond already covered. Sovereign gold bond, SGB, SGB, sovereign gold bond. Now, what is the idea of a sovereign gold bond? Simple. Sovereign means issued by the government. Correct? Sovereign means issued by the government. So, sovereign gold bonds are basically government bonds, government securities. They have a maturity period of 8 years. Right? They have a maturity period. Instead of have, I'll have to use now had. Because for the last 1.5 years, the government of India stopped issuing sovereign gold bonds altogether. It has not issued any kind of a sovereign gold bond in the last 1.5 years. But anyways, sovereign gold bonds are government bonds. They have a maturity period of 8 years. And the whole idea is, instead of investing and purchasing gold from the market, the government simply says, purchase the bonds. Purchase the bonds, right? If you want to purchase 1 gram of gold, rather than purchasing physical gold, now pay the same amount. I will give you 1 gram worth of sovereign gold bond. Simple. Rather than investing in physical gold, securities, right, you will have to purchase. That is basically the idea of a sovereign gold bond. The government also said, you do not have to be worried about purity, because if you purchase gold, you will have to be worried about purity. And by the way, because I'm talking about purity, in today's newspaper, there was an update. I'm pretty sure all of you heard of hallmarking of the gold. Please do let me know. Hallmarking of the gold. Right? The government of India had introduced the hallmarking of the gold in certain districts, and had made it mandatory. Now, according to the latest guideline which has been issued by the government of India, hallmarking has been extended to around, I'm not able to recollect the exact number of the districts, but it is around 380 or 90 districts now. From 200 plus districts, now it is almost 380 or 390 districts. In these districts, if anybody has to sell the gold, it has to be hallmarked. Hallmark means when you go to, right, let's say a jewelry shop, you want to purchase a jewelry, check it. There will be certain markings done. What is the quality? What is the purity? Right? That is hallmarking of the gold. Right? So hallmarking, this was there in today's newspaper. I thought just let me connect it. Anyways, come back to the idea. Whenever you're investing in the gold, you're worried about the purity. But here, you do not have to be worried about purity. You invest in gold, it will not give you any interest. Here, the government will give you interest. The government would announce interest on this, etc. Right? And the government also said after certain time period, these are tradable in the market. You can trade them in the market, etc. So this is essentially the concept of a sovereign gold bond. And upon maturity, that is after the completion of 8 years. 8 years is the maturity period. Upon maturity, whatever is the gold price on the 3 preceding days from the date of maturity, in the last 3 preceding days, whatever was the gold price, the government will give you the average of that upon the maturity of the sovereign gold bond. Is everybody okay? Which means if the gold prices will go up, your value of the bond will also go up. If the gold prices will go down, your value of the bond will also go down. That is essentially the idea of a sovereign gold bond. And why it was there in the discussion, right? During the budget, the government of India has made a very important change. Please remember this. The government simply says, if you have any kind of a capital gains, in case of sovereign gold bond, if you have enjoyed capital gains, then the only way I will give you exemption in the capital gains taxation will be if you have purchased the bond directly from the government and held on to it for 8 years. Is my statement clear to all of you? I'll repeat it again. What has the government of India announced in the budget? The government of India has made a very simple announcement. If you have purchased this particular bond directly from the government, that is primary market, directly from the government, and you have held on to this particular bond for 8 years, and after 8 years the government will give you returns, right? Market price of the gold has increased obviously in the last 8 years, so there is certain capital gains. Now there is a capital gains taxation. Government of India simply says the tax exemption on this capital gains will be given to only those investors who have purchased the bond from the primary market, held on to it for 8 years. If you have got capital gains in any other case, sir, what do you mean by any other case? Imagine, I have a sovereign gold bond, right? I've purchased it from somebody else in the market. I purchased it at 92,000 rupees. I will sell it to you at 1 lakh rupees. Is there a capital gains? Simple question, by the way. Is there a capital gains? Yes. How much? Don't worry about indexation, etc. 8,000 rupees. Government simply says, on this capital gains, government will impose tax and collect. Government will simply impose tax and collect. I purchased a bond from you. Imagine, okay, one more example. I purchased the bond from you. It was the 7th year. I purchased this sovereign gold bond. Now I've kept it with myself. 8 years is over, right? Earlier it was there with you. Now I've purchased it. 8 years is over. So maturity period of the bond is over. I will receive certain amount of money from the government now, right? Let's say when I purchased it from you, I paid you 90,000 rupees. Now the government will give me 1 lakh rupees because that is, let's assume, the market price of the gold. So again, there is a capital gains, 10,000 rupees. Government will simply say, no tax exemption on the 10,000 rupees. I will impose a tax and collect it. So again, I'm repeating this. I'll repeat the statement. Listen to me carefully. There are multiple ways through which you can make capital gains in the context of sovereign gold bonds. The government will impose a capital gains tax on all the instances except only one instance. That is, in this case, you purchase the bond directly from the government in the primary market. When they issued, you purchase it directly from the government. You have held on to the bond for 8 years. Now the bond has matured. Only in this case, no tax on capital gains. In all the other instances, capital gains tax will be imposed and collected by the government. Is everybody okay? Please do let me know. Done? Everybody is okay? So these are certain important points, right, in the context of the debt market, right, in the debt market. So we are done with the debt market. Now let's take a break. After the break, I'll start with equity market. After the break, I'll start with equity market. So time is 5:53. Okay. So let's restart the session at 6:10. Is it okay? Right. Let's restart the session at 6:10. Baba, not 30 minutes. Not 30 minutes. For dinner, I'll give you 30 minutes. For this, no, not 30 minutes. 6:10. Let's restart the session at 6:10 p.m. Please come back at 6:10. Okay, welcome back. Am I audible and visible? Please do let me know. Those present in the session, please do let me know. Am I audible and visible? Okay, great. Let's start then. Let's start. So, what we are discussing financial market. I know a lot of you would have already forgotten, right? Once you take a break, even everything would have gone out of your mind. So, what are we discussing? We have started revising financial market. In the financial market, we are done with the money market. We are looking at the equity market now. I'm sorry, the capital market. In the capital market, we have taken care of the debt market. We are supposed to start with equity market. Correct? We are supposed to start with equity market. Just a reference point. This is where we are in the mind map. This is where we are exactly in the mind map. That is in the equity market. Let's start. So, what is equity market? Like I said earlier, equity market essentially means a market where the company will issue ownership. Company will issue shares. Simple. The company will issue shares and raise money, right? Raise money for different purposes. The purpose can be investment purpose, right? That is investing in a new company or new manufacturing facility. Investment, right? Let's say in the form of buying a new company. Investment in the form of purchasing asset, or let's say purchasing machinery, etc. So basically, the company now will use the equity market. Now, what are the important points in the equity market? When I say the company is going to sell the ownership, right? So when I say company is going to sell the ownership, essentially the company will use a route that is called as IPO. All of you heard of this? IPO. What is IPO? Initial public offering. IPO stands for initial public offering. Right? So whenever a company which has not issued the shares to the public, it's very important. To the public. To the public means you and me. The shares of this company are not available in the market, are not there in the market for trading purposes. Right? That is basically unlisted company. It is unlisted company. Please understand the concepts very carefully here. Can an unlisted company issue shares? Yes. Can they sell equity? Yes. They can basically go to, let's say, Shark Tank, for example. Sir, what do you mean by that? Let's say Shark Tank. You have a company completely owned by you. You will go to a Shark Tank. They will basically make fun of you in the beginning. You will also make certain jokes. You will also give certain data to them, and they'll basically say, I want 5% ownership and I'll give you 50 lakh rupees. I'll give you 10 lakh rupees, etc. So argument is very simple here. When you say unlisted company, does it mean the ownership is not given to, or equity is not given to other investors? Yes, you could have already done that. But please understand that is not IPO. That is not an IPO. For example, you have given to, right? So you have taken 20 lakh rupees from an investor. You give 5% ownership to the investor. That is fair enough. So equity is already there. But please understand, these particular shares right now are not there in the market. These are not available for investors such as you and me for purchasing, by buying, for trading purposes. Right? Everybody is okay. But when the company will do this, that is, the company will issue the shares to the, right, let's say, investors in the market. To investors. What kind of investors? It could be retail investors. It could be retail investors. Retail investors are you and me. It could be high net worth individuals, HNIs. It could be financial institutions, etc. So when the company will issue the shares for the first time ever, and the shares of the company are there in the market for trading purposes, that is called as an IPO. We say this company now is a listed company. Is everybody okay with the idea of an IPO? Please do let me know. Everybody is okay with the concept of a listing and unlisted company? So when you say a listed company, simple. IPO is already done. The shares of the company are there in the market for trading purposes. Now, whenever the company has already done IPO, The company now in the future, let's say 15 years later, 20 years later, again wants to issue shares. The company again wants to issue shares. Are they allowed to do that? Of course, yes. But please understand that is called as FPO. Is it okay? Right? So once you have done for the first time, when you have done it for the first time, IPO. Any subsequent issue, I repeat, any subsequent issue, that is called FPO, follow on public offering, further public offering. Is everybody okay with the idea of an IPO and FPO? Please do let me know. Everybody is okay with the idea of an IPO and FPO? What is the difference between a listed company, unlisted company, etc., etc.? So some of you might be thinking, sir, IPO and FPO, is it the only way to sell ownership in the market? No. No. Only an IPO is the way to sell ownership in the market? No. There is a term called as private placement. There is also something called as a private placement. What is the basic idea of a private placement? Rather than going through the process, for example, an IPO, rather than going through this particular process, trying to find, let's say, a merchant banker, right, trying to basically decide in what way I want to sell the shares, how many shares I want to sell, what is the valuation, etc., etc. It's a time consuming process. It doesn't happen very quickly. Is there any other option for you as a company? Is there any option? Basically, there is something called as a private placement. What is the idea of a private placement? There are two types of private placement. One is called as, right, the qualified institutional placement. One route is called as qualified institutional placement, QIP. What is this idea of a QIP? In case of idea of a QIP, basically the shares of the company are sold to certain identified institutions. Sir, what do you mean by institutions here? Institutions such as mutual fund companies, institutions such as insurance companies. So you will sell the shares, that is equity of the company, to certain identified institutions, hence called as qualified institutional placement. Right? And there is also one more route, that is a preferential allotment. Preferential allotment. What is this idea of a preferential allotment? You will be allocating the equity, right, to certain types of investors. For example, it could be promoters of the company. It could be any other investor in the market, etc. So you can also go for a private placement. But please understand, when you go for an IPO, it simply means the shares are there in the market. You can purchase the shares. I can purchase the shares, right? I can sell the shares, etc., etc. Is everybody able to understand IPO, FPO, private placement, these kind of terminologies? Everybody is okay? Now, once I say it is listed, what do you mean by listed here? You have heard of stock exchanges. I'm going to the next concept now. You have heard of stock exchanges, right? Sir, what do you mean by stock exchange? You will have heard of BSE, correct? Bombay Stock Exchange. You will have heard of NSE, National Stock Exchange, right? These are the two major, I'll repeat, these are the two major national level stock exchanges in India. Does it mean only two exchanges are there in India? Absolutely no. There are regional exchanges as well. But regional exchanges are not very important for you. Focus on the national exchanges. The BSE is one of the oldest exchanges. In fact, in India, this is the oldest exchange, and later we have NSE. Right? In case of BSE, if you are listed, right, the trading of the stocks are done. The stock market prices can go up, can go down based on the demand and supply of the shares, etc. But in case of BSE, please understand, the term that you need to remember is Sensex. And in the last 1 week, please don't tell me that you have not come across the term Sensex in the newspaper. Sensex. Sensex is basically a combination of two terms, sensitivity index. It is a combination of two terms, sensitivity index. And what do we do in case of Sensex? we calculate the market capitalization. And when I say market capitalization, free float market capitalization of 30 companies. Free float market capitalization of 30 companies. And we publish the change in the market capitalization. And that number is nothing but Sensex. Is everybody okay? Please do let me know. What is a free float here? Free float is simple. Imagine a particular company is there. The company's total number of shares are, let's say, 5 lakh. I'm taking simple number to make you understand. Let's say there is a particular company. Total number of shares of the company are 5 lakh. All the 5 lakh shares are not available in the market for trading purposes. Some of the shares are held by promoters. Right? And generally it is very, very high number in some of the companies. Let's say out of 5 lakh, imagine 2 lakh shares are held by the promoters. Right? Which means only 3 lakh shares are available for trading purposes. This essentially the 3 lakh shares are called as free floating shares. Is it okay? Please do let me know in the chat section. And I want you people to participate. I'm not expecting essay from you in the form of replies. Yes, no, right, thumbs up, thumbs down like this. I will realize whether you're following the discussion or not. Okay, so free float capitalization, free float market capitalization of 30 companies is calculated, and this is published in the form of a number, and that is called as a Sensex. Done. Now what about NSE? NSE, National Stock Exchange. In case of NSE, we have an indicator Nifty. We have the indicator Nifty. Right? Nifty essentially is a combination of two terms, NSE plus 50. NSE plus 50. That is, instead of the 30 companies, instead of having group of 30 companies as done in BSE, in NSE, we are taking the market capitalization of 50 companies. Simple. We are taking the market capitalization of 50 companies. That is the reason it is called as Nifty 50. Everybody is okay? Can I go forward now? So BSE, Sensex. NSE, Nifty, they'll say. BSE, Sensex, NSE, Nifty. Now, I'll repeat this again. Listed, unlisted. Meaning what? Listed company means the shares of the company are available for trading purposes in the market. Right? Is it okay? Shares of the company are available. For example, can you find the shares of Infosys in the market? Right? Yes. In the stock market, you can buy and sell Infosys shares. What about Wipro? Yes. Zomato, Swiggy, Paytm? Yes. Right? Whereas, right, there are other companies whose shares are not available in the market. Best example, Unacademy. Right? Best example, Unacademy. Can you find the shares of Unacademy in the stock market? No. Unlisted company. Simple. Listed, unlisted. Done. Can we go forward? Can we go forward? Alright, don't enter into the details. Right? What is the candlestick? What is index divisor, etc. Right? Those are not relevant for UPSC exams. Please stick to whatever is requirement for the UPSC examination. Because I hope you understand, within BSc itself, you can spend 10 hours and that will be barely scratching the surface of the index, by the way. So what is required for UPSC? Let's stick to that. So BSc and NSE. Now please understand, once the IPO is done, the stock or basically the shares of the company are traded in the BSc or NSE like this. So this BSc or NSE or BSc and NSE is called as secondary market. Is it okay? The BSc and NSE is referred to as secondary market. What do you mean by secondary market? Secondary market basically refers to the market where already existing instruments are traded. Already existing instruments are traded. At primary market, new issuance will happen. In the primary market, new issuance will happen. In the secondary market, existing instruments are traded. Is everybody okay? If at all a question is asked in the UPSC examination, for example, let me see how many of you will be able to answer the question. which of the following, right? This is my question. Orally, I'm telling you now. Which of the following are examples of secondary market in India? E-Kuber, right? One, E-Kuber. Second, NSE. Third one, NDS-OM. And the fourth one, BSE. Please tell me, which of the examples or which of the following are examples of secondary market in India? Let me know. Start answering, right? So I've given you 1, 2, 3, 4. Which of these, right? Please tell me the serial number. Right? Don't tell me 2 of them, 3 of them. No, tell me serial number. 1, 2, 3, 4. Which of these are examples of secondary market? 2, 3, 4. Right? Neha, 2 and 4. Vyom, 2, 3, 4. Right? Some of you are saying 2 and 4. Okay, great. 2 and 4. Ambika, all. Okay, great. My dear, NSE is a secondary market. Correct? NSE is a secondary market. That should be very clear to you. NDS-OM, negotiated dealing system, order matching. It is a secondary market for government bonds. Government securities. It is a secondary market for government securities. BSE is also a secondary market. Now please listen to me carefully. When I asked you question, I said which of the following are examples of secondary market. I did not specifically ask you for a bond or for a share. If in the exam, if they ask you secondary market for a bond, you can find out. If they ask you secondary market for a share, you can find out accordingly. But here it was a very generic statement. Which of the following are examples of secondary market? So NSE correct, NDS-OM correct, and BSE also correct. Is everybody okay? Do let me know. Can we go forward now? All of you are able to follow the discussion that we are doing? Do let me know. All of you are able to follow the discussion that we are doing? So capital market, the debt is done, equity is done. Now please listen to me carefully. Sometimes you will come across the term share. Okay, sometimes you will come across the term share. Sometimes you will come across the term equity. Some of you will ask, is there any difference between both of them? Are both one and the same, or is there any difference? Listen to me carefully. Share represents individual units. Share represents individual units of ownership, whereas equity generally represents percentage ownership. Is it okay? Equity represents percentage ownership. Meaning what? Let's say a company has total 5 lakh shares. Out of that, if you have 2 lakh shares, you have 2 lakh units of ownership out of 5 lakh units. But 2 lakh out of 5 lakh will become 40%. You will simply say, I own 40% equity. Is it okay? You will simply say, you own 40% equity. All of you are able to understand the difference between, right, equity, share. Sometimes instead of the term equity, they will also use the term stake. They will also use the term stake. Stake also represents percentage ownership. Okay. Now, when you talk about shares, there are essentially 2 types of shares. There are essentially 2 types of shares. One is called as a preference share. One is a preference share, and the second one is called as equity share. Preference and equity. What is the difference? The preference shares, if anybody has purchased them, then the annual dividend that is given to you is fixed. The dividend that will be given to you by the company, and of course, please understand, the dividend is always given from profits. The dividend is always given from profits earned by the company. So the dividend that is given to you annually by the company, it is fixed. 4 rupees, 3 rupees per year, etc., etc. Whereas equity shareholders, the amount of dividend that is given to you is not fixed. It will vary from 1 year to next year. And the dividend is given to the equity shareholders after giving the dividend to preference shareholders. First dividend will go to preference shareholders, then equity shareholders. This is one very important distinction. Second very important distinction is, some of you will be thinking, then I will only purchase preference shareholders, I will not purchase equity shareholders. No. The preference shareholders do not have any kind of a voting power, whereas equity shareholders will have voting power. Is everybody able to understand the difference between the preference shareholder as well as an equity shareholder? Please do let me know. Everybody is okay with the difference between preference shareholder and equity shareholder? Okay. Right. So these are certain important points I wanted to discuss in the context of capital market. Can we go forward now? Do let me know. Money market is over. Capital market is over. Can we go forward? Anybody has any kind of a confusion, doubt so far? Great. Let's go forward. I know a lot of you will be thinking, no, sir, no doubt. Please go forward. Go forward. Finish it as soon as possible. I'm fed up of economic class. I want you to say the economy is over. I'm waiting for that particular statement, you will say. No, long way to go. Next, bonds, convertible, non-convertible, masala, zero coupon. Now, there is one more term I've written here. Let me explain this. Zero coupon, zero principal bonds. Okay, zero coupon, zero principal bonds. Now, what is this idea of a zero coupon, zero principal? Let me explain in a separate page here. Now, please do let me know in the chat section, how many of you have heard of social stock exchange? Yes, SE. Social stock exchange. There is a separate, right, basically window, basically facility within NSE and BSE, which is called as social stock exchange. What is this idea, right? It's a circuit. They'll basically use the term, there's a separate circuit. Separate circuit means within the BSE and NSE, there is one facility for social stock exchange. What is the idea of a social stock exchange? Listen to me carefully. Let's say there is a charitable organization. It is involved in providing, let's say, education to blind people. Hypothetically, okay? Blind people. You have lot of money. Now, the owner of that particular charitable organization will come to you and they will ask you for donation. They will simply show you the photographs. They will show you, right, let's say the recommendations, etc. And they will ask you for donations. Now, you want to make donations, right? You're not saying that you will not make. You are willing to provide donations. But there is a concern. You have a concern. What is a concern? What is the guarantee that the money that I will donate will be used for charitable purposes only? Correct? Everybody is able to understand? You have a concern, and that's a valid concern, by the way. Nothing wrong with that. Your concern is how to ensure that the money that you donate will be used for the right charitable purpose. What if it is misused? What if it is, right, basically a fraud, right? You have been cheated of your money, etc. For these particular purposes, in order to attract donations from the market, from the donors, now there is a separate facility which is called as a social stock exchange. In this particular social stock exchange, these non-government organizations which are involved in charitable work, etc., they will issue bonds. And these particular bonds are called as zero coupon, zero principal bonds. Is everybody okay? Zero coupon, zero principal bonds. Now, why it is called as a zero coupon and zero principal? Here is a charitable organization. They will issue the bond to you. You will give the money to this charitable organization. Now, they will collect the money. And please understand, it's not your investment. It is essentially donation. It is not your investment. It is essentially a donation. Now, this charitable organization will collect the money, use it for the charitable purpose. But again, some of you will ask me, sir, how do I ensure that the funds are used for the right purpose? There is accounting mechanism, and that is the reason we have formalized the system here. There is an accounting mechanism here. That is, annually audits have to be conducted. The reports have to be published if you are raising the funds through social stock exchanges. Is it okay? Right? You will have to undergo all of these checks and balances that will ensure that when you invest in the zero coupon, zero principal instrument, you are sure that the funds are not misused. There is no diversion of the funds. There is no abuse of this particular facility. And why these instruments are called as zero coupon, zero principal instrument? Neither you will get any coupon on this, nor will your principal amount be returned to you. It's basically a donation. Neither are you going to earn any interest on it, zero coupon, nor your principal amount will be returned. That is zero principal. Is everybody okay with the idea of a social stock exchange? Do let me know in the chat section. Everybody is okay with the idea of the social stock exchange? If at all a question is asked on zero coupon, zero principal, will you be able to answer the question? And by the way, sir, who will regulate all of it? My dear, if you're talking about exchange, be it zero coupon, be it indexed, etc. If you are talking about exchange, it will come under regulation of SEBI. Simple. If you are talking about exchange, it will come under the regulation of SEBI, Securities Exchange Board of India. Okay, let's go forward. Right, so next important current affairs, external commercial borrowing. Listen to me very carefully now. External commercial borrowing, ECB. What is this idea of an external commercial borrowing? Let's go point by point. Under the ECB, Indian companies, I repeat, Indian companies, right? What kind of companies? The companies which are operating in an industry where FDI is allowed. Companies which are operating in an industry or a sector where FDI, foreign direct investment, is allowed, these companies can go to external market, borrow from external market. Is it okay? Borrow from external market. Right? This particular borrowing could be in the form of rupees, that is domestic currency, or else it can also be in the form of foreign currency. Is the point clear? You can borrow from, right, external market either in the form of a domestic currency, for example, masala bonds. You can also borrow in the form of foreign currency, right? So what kind of foreign currency? We use the term freely convertible currencies. Freely convertible currencies. For example, dollar, euros, etc. So maximum amount of borrowing. This is important now. Why? Lot of changes have been done very recently. So be ready for questions on this. So the maximum amount of money that you can borrow under the route of external commercial borrowing. Now, anybody knows how much is the amount now? Please do let me know in the chat section. $1 billion or 300% of net worth of the company, whichever is larger. Is the point clear? How much you are allowed to borrow under the ECB route? $1 billion or 300% of the net worth of the company. Net worth basically means difference between assets and liabilities. Difference between assets and liabilities, that is called as a net worth. So either 1 billion or 300% of your net worth, whichever is larger, you can borrow under the route of ECB. Now, how you can borrow? Essentially, there are two routes under ECB. One is called as an approval route. One is called as an approval route. That is Reserve Bank of India. Please remember, regulation of this comes under RBI. RBI will determine, for these purposes, you will have to take my permission first. That is called as approval route. And another route is automatic route. Automatic route, basically RBI simply says, if you are this kind of a company, if you want to borrow for these kind of purposes, you do not require any kind of a approval, you do not require any kind of a permission. You can simply bring in the dollars or bring in the rupees under this particular route without any approval. Everybody is able to understand approval route is there and automatic route is also there under the ECB. Right? Everybody is okay with the idea of a ECB? Please do let me know. My dear, can the state government borrow? Right? Look at the expansion, external commercial borrowings. Do you think the state government will be allowed to borrow under this route? No, they can borrow. Generally, they can borrow, but with the approval of Government of India. With the approval of Government of India, right? Because Article 293, Constitution, etc., you will have to be knowing all of that. If a state has any kind of a liability towards the center before they are borrowing, they will have to take the permission, etc., etc. So can the states borrow? Yes, states can borrow, but this is for commercial enterprises. This is for commercial enterprises. Okay, can we go forward now? These are certain important points in the context of external commercial borrowing. Do let me know. Can we go forward? I want an answer from all of you now. Otherwise, I'll stop the session. I'll simply say, yes, sir, great. Stop the session then. Okay, so external commercial borrowing, please update. Lot of information is there in the current affairs. Next, alternate investment funds, AIF. Alternate investment funds, AIF. Now, what is this alternate investment funds? Please understand, one is a traditional investment. One is a traditional investment. Traditional means what? You're going to invest, let's say through broker or by yourself. You will invest in a bond. You will invest in a fixed deposit. You will invest in the shares, etc. But in addition to the traditional investment, there is also one more type of a investment vehicle that is available now. That is called as alternate investment funds, AIF. Alternate investment funds. Now, what is the basic idea of an alternate investment funds? Under this, again, regulated by SEBI. These are regulated by SEBI only. Right? So, under this, there are essentially three categories of investors. There are three categories. Right? They are classified into AIF 1, AIF 2 and AIF 3. For example, there are high net worth individuals. High net worth means those who want to invest, let's say 1 crore rupees. Those who want to invest 5 crore rupees. Those who want to invest 10 crore rupees. And obviously, when I say this, I'm pretty sure neither am I an HNI nor you are HNI. Right? I don't know about you, but I know for sure I'm not an HNI. So argument is very simple here. These will focus on one, high net worth individuals, will focus on, right, let's say financial institutions. These will focus on sovereign wealth funds, etc., where they want to invest huge sums of money, not small amount, huge sums of money. Generally, they will have requirements such as your net worth should be so and so. Your annual salary should be so and so like this. So these kind of, let's say, high value investors are targeted and they will provide the services. That is essentially a manager is there, fund manager. Their investments are taken and these investments are done in the market. Right? That is essentially called as alternate investment funds. Is everybody okay with the idea of a AIF? Again, I know somebody will ask me, sir, any difference between a mutual fund and AIF? In mutual funds, you can invest very small amount of money. In AIF, the investment requirements are very, very high. Is everybody okay? So AIF. Next one is concept of ETF. What is this idea of an ETF? ETF stands for Exchange Traded Fund. Exchange Traded Fund. Right? ETF essentially stands for certain securities. Okay, it is representing a portfolio of securities. Portfolio. For example, let's say there is an ETF wherein one unit, it's just like a share, by the way. Is it okay? Please don't overcomplicate everything. Please don't overcomplicate. Let's say you want to purchase a shares of company A, B and C. You can go to the stock market, and when I say you can go, not literally, you can log on to your Demat account and through the brokerage account, you can purchase the shares. That is possible. You want to sell the shares, you can do that through the Demat account. But instead of doing this, purchasing of the shares of the companies individually, purchasing the shares of the banks individually, selling them individually like this, can you basically purchase one instrument which will represent shares of, let's say, multiple companies? Everybody is able to understand? Can you purchase, right, one instrument which will represent, let's say, gold? Can you purchase one instrument which will represent silver? Yes. The basic idea of ETF is this. That is, ETF can be for commodities. ETFs can be for commodities. For example, we have gold ETF. We have silver ETF. And we also have ETF for multiple companies also, that is representing the shares of the company. For example, one ETF will basically represent the shares of, let's say, 10 public sector enterprise. Simple hypothetical example I'm saying. 10 public sector enterprises. So if you purchase one ETF, you have purchased the shares of 10 CPSEs. If you sell this ETF, you are selling the shares of 10 CPSE, the shares of 10 CPSEs. Everybody is able to understand what is the idea of an ETF? ETF is basically an instrument just like a stock. Just like a stock, it is also an instrument, but it will represent something else. This can represent, right, let's say shares of other multiple companies. This ETF can represent a commodity such as gold, can represent a commodity such as silver. So instead of trading in them, right, which could be a time consuming process, which could be a costly process for you, you will basically purchase ETF, sell ETF. It will help you diversify. It will help you in reducing the cost of the transaction, etc. Is everybody okay with the idea of ETF? Please do let me know. I'll go forward to the next one, mutual fund concept. ETF can be traded in any time. My dear, market has to be open for this. Simple, market has to be open because these are listed. Simple, I hope you understand. Don't overcomplicate everything. These are listed because I told you this statement. These are just like stock. These are just like stock. Stocks are listed. ETFs are also listed. So you can buy when the market is open. You can sell them when the market is open. Same, right, as a stock, but only difference is stock, you will have to buy them individually, sell them individually. ETF represents maybe group of shares. ETF represents, right, a commodity like this. Okay, let's go forward. Mutual funds. Right, mutual funds sahi hai. I'm pretty sure a lot of you or all of you would have heard of this particular statement. Mutual funds sahi hai. Now, what is this idea for mutual funds? Please understand, mutual funds is also type of a investment vehicle. Simple. It is also type of investment vehicle. Sir, what do you mean by investment vehicle? You want to invest in the market. One way to invest in the market is through mutual funds. Is it okay? One way to invest in the market is through mutual funds. And basically, be it ETF, be it AIF, be it, right, let's say mutual funds, all of them talk about stock market, all of them talk about bond market, etc. Trading in the market, it has to be regulated by SEBI. It has to be regulated by Securities Exchange Board of India. And by the way, before I go forward, let me ask you one question. Is SEBI a constitutional authority or a statutory authority or an authority set up through executive resolution as of now? The current status I'm asking, current status. According to you people, what is the status? Right? What is the correct answer? Is it a body which is a constitutional authority or a statutory authority? Do let me know the answer very quickly. Right? Let me continue with the mutual funds here. Statutory. Statutory. All of you have said statutory. Anybody will say, right, it's a constitutional body? Anybody will say, no, sir, it's a constitutional authority under article this, etc. Statutory authority. In fact, please remember, SEBI was actually established in the year 1988. It was actually established in the year 1988. Later, 1992, the government of India gave it a statutory status. And that was basically after a scam in the stock market. Right? There was a scam. Don't worry about that. Don't do a PhD on that for UPSC examination. Not relevant for UPSC. But anyways, come back to the discussion. Mutual funds. What is the basic idea for mutual funds? Mutual funds are an investment vehicle. Right? What is the basic model of a mutual fund? Right? Let me explain that with a flow chart here. Let's imagine here are investors. Investor 1, 2 and investor 3. Okay, mutual funds. I'll write the headline here, mutual fund. So there are different types of investors. Now these investors will invest and purchase certain units, that is instruments. They will give money and in return they will get certain instruments from a mutual fund company. Okay, so mutual fund company will give them instruments in return. Now, these instruments are nothing but mutual fund units. So far, the picture is okay with all of you? Please do let me know. So far, the picture is clear, right? They will in return get certain units, that is instruments. You have given money, you should get certain instrument. Now, the mutual fund company will use this money to invest in the market. They will purchase, let's say, bonds of different, right? Let's say different types of bonds. It could be, right? Let's say bonds of a private sector company, bonds of state government, bonds of central government. They will invest and purchase shares in the equity market. It could be shares of public sector enterprise. It could be shares of private sectors, etc., private sector companies, etc. So they will essentially manage the assets. Please understand. The mutual fund company will essentially manage the assets. Buy, sell, right? Again buy, sell, like this. And right, because they're managing the assets, these are also referred to as asset management company. Is it okay? A lot of times you'll come across the term AMC, asset management company. That is the reason these are called as AMCs. Done? Right. So whether you have invested in the equity mutual fund, in that case, most of your investments will go into the equity market. If you have invested in the debt mutual funds, in that case, most of your investments will go into the debt market. And according to the returns that are generated by the mutual fund company, of course, as there are certain charges, they're not doing charity, they will impose and collect certain charges, and they will give you returns based on how your portfolio, that is in which instrument your investments have gone, how your portfolio has performed. Based on that, they will give the returns to you. Everybody is okay? This is basically the idea of a mutual fund company. Is everybody okay? Please do let me know. With that, basically we have completed one more part of, right, let's say the static portion, that is the financial market. Can we go forward to the next chapter now? Those present in the session, please give the confirmation. Can we move on to the next chapter? Anybody has got any kind of a doubt in the financial market? Do let me know now. Otherwise, I'll go to the next chapter. No doubts? Is there a lock-in period for mutual funds? Please understand. If it is an open mutual fund, then there is no lock-in. If there is a closed mutual fund, closed means essentially for some time period, you cannot, right, return the mutual funds. There is a lock-in period like that. It all depends on the kind of mutual funds, but please understand, right, different varieties of mutual funds can be issued. Different names are there, but don't worry about all of it. Okay. Redeemed, my dear, redeemed means you are returning the bond upon maturity. You are returning and getting the money. Okay, that is basically the concept of redemption. Right, that is basically the idea of a redemption. Done? Okay, let's go forward. Next important chapter I want to discuss with you people is agriculture. Right? In agriculture, what are the important points? Let's go one by one, right? We will take up the headlines and discuss important points of each of these particular, right, let's say headlines. First one is MSP. Most important according to me. First one and the most important one is MSP, right? What is MSP? Minimum support price. MSP stands for minimum support price. Now, what is this idea of a minimum support price? The minimum support price is the price that has been announced by the Cabinet Committee on Economic Affairs, decided by the Cabinet Committee on Economic Affairs, and it is the price at which the government will procure the food grains irrespective of whatever the market price is. Is the point clear to all of you? I'll repeat it again. It is the price that has been announced by the Cabinet Committee on Economic Affairs. And it is at this price that the government will procure the food grains from the farmers irrespective of market price. Because the market price is determined by supply and demand. Correct? The market price is determined by supply and demand. And when the market prices are determined by supply and demand, the market prices for same crop at one time could be very high. In another time could be very, very low. The prices are fluctuating in the market because of supply and demand fluctuation. But the government of India, once they announce a MSP, come what may in terms of the market price. If the market price is much higher than the MSP, doesn't matter. If the market price is much lower than the MSP, doesn't matter. The government of India will pay the MSP and procure the food grain from the farmer. Right now, please understand, there is no law. This can be asked in the prelims examination. Right now, there is no law which mandates that there has to be an MSP. Which means there is no legal, right? There is no legal provision. There is no provision which has a backing of MSP, which gives a backing to the MSP. Sir, what do you mean by that? I'll just give you an example to make you understand. All of you have heard of National Food Security Act? Do let me know. All of you have heard of National Food Security Act. Under the National Food Security Act, there are provisions. That is, there is a legal right for you to get 5 kgs of free food grains now. It's a legal right. 5 kgs of free food grains have to be given to you if you are a beneficiary under NFSA. Right? That basically means there is a law. Under the law, there is a provision, and the provision mandates that you have to get 5 kgs. There is no such legal provision for MSP. Is it okay? That is the reason there is a demand from the side of the farmers. They're demanding that there has to be legalization of MSP. Correct? There has to be legalization of MSP. Has it been accepted by the government of India? Has government of India legalized MSP? Right now, no. Right now, absolutely no. So government of India, that is Cabinet Committee on Economic Affairs, essentially announces MSP for 22 crops before the sowing season begins. Before the onset of the sowing season. That is, even before the farmer will start sowing the seeds and start the cultivation cycle, even before that, the Cabinet Committee on Economic Affairs announces that this is the MSP I'm going to pay. And why is it done? It is done in order to keep the farmers informed. To keep the farmers informed so that the farmers will realize this is the crop I need to cultivate. So that when I sell it to government, this is the amount of money, irrespective of the market prices, I will be earning from the government. Right? That's the reason even before the sowing season starts, the crops MSP is announced. Now when I say 22 crops, which are the 22 crops? Please have a look at the list here. My suggestion, please go through the list. Try to memorize at least the important ones. Try to memorize at least the important ones. Why? UPSC has the habit of asking question on the list of the crops covered under MSP. Bad habit, but you can't escape. UPSC has the habit. For example, what crops were there in the newspaper? Right? Have a look at this. Was maize present in the newspaper's discussion? Maize. Think of it. Right? Paddy. Anyways, paddy and wheat always are present. Paddy and wheat always are present in the discussion. But maize, yes, very recently it was there in the discussion. Right? What about moong, urad, right? Gram, arhar, etc. These were also there in the current affairs discussion. Right? For example, the soya bean, it was also there in the discussion. Right? Sunflower, right? Cotton, copra, right? Cotton, copra and jute. These were also there in the current affairs. So please be very careful. UPSC can ask you a question. Try to go through the list once or twice. You'll be able to find out whether this crop is there or not there. But what UPSC can also do is, they can simply ask you whether it covers only commercial crops, whether it covers only oilseeds, or it covers only pulses, etc. like this. That kind of a question can also be asked in the prelims examination. So cereals are covered, pulses, right, oilseeds, sunflower, right, oilseeds and commercial crops. These are the 22 crops which are covered under the MSP policy. And Before the government, that is the Cabinet Committee on Economic Affairs, announces, right, announces what is the MSP, the recommendation to the Cabinet Committee on Economic Affairs is given by one more authority, that is Commission for Agriculture Cost and Prices. CACP will give the recommendation to Cabinet Committee on Economic Affairs, and the Cabinet Committee on Economic Affairs will announce what is the minimum support price. Is the point clear to all of you? Now, on what basis the CACP will give the recommendation? CACP through multiple reports will give the recommendation, but on what basis? What are the factors basically covered, right, or included to decide what should be the recommendation? These are the factors. Please go through these particular factors as well. Question can be asked in the prelims examination. For example, what is the cost of cultivation of the crop? What is the cost of cultivation? What are the demand and supply situation in the domestic market as well as global market? What are the price trends in the domestic as well as global market? Intercrop price parity. A lot of you will start typing on this only. Sir, what is intercrop price parity? What is the terms of trade? Tell me. I want to understand everything in detail. Basic idea. Intercrop price parity means what is the price in the context of one crop compared with another crop. Simple. The price of one crop compared with another crop. That is intercrop price parity. Why? Why should you compare the prices of two different crops here? Simple. If for one crop MSP is very, very high, and if for another crop MSP is very, very low, don't you think Government of India itself is signaling the farmer to cultivate only the first crop, not the second crop? Everybody is able to understand? Government of India itself is signaling to the farmer, right, to cultivate more and more first crop. Don't cultivate the second crop. And what if the first crop is highly water intensive? What if the first crop is highly water intensive? For example, rice. Right, I'm using the term rice, but essentially what they will say in MSP policy is paddy. They'll simply say paddy. Okay. So everybody is able to understand. So what is the price for two different crops? That is intercrop price parity. Terms of trade. Right. Terms of trade essentially, right, refers to the prices, difference of prices, or basically the comparison of prices between agriculture commodities as well as non-agriculture commodities, because the farmer has to purchase even the non-agriculture products. So comparison between the prices of agri products as well as non-agri products, right? So intercrop price parity, terms of trade, effect on the price policy on the rest of the market, and finally, right, have a look at this, minimum 50% additional margin to be given to the farmers. Minimum 50% additional margin, meaning what? Right now, if you know the formula, what is the formula announced by the Cabinet Committee? The formula is MSP is equal to 150% of cost of production. Correct? MSP is equal to 150% of cost of production. Right? Why 150%? Right? Why not just 100%? Reason behind this is the government simply says, if I pay 100%, essentially I'm giving the money that has been spent by the farmers. Rather than that, if I give 150%, it simply means compared to their investment or compared to their expenditure, I'm giving them additional 50% returns. That is the reason the formula is 150% of cost of production. Is everybody okay with the discussion so far? Please do let me know in the chat section. Please do let me know in the chat section. Everybody is okay with the discussion so far? Right? Now, this is associated with MSP of the central government. Now, in addition to this, in addition to the MSP that is paid by the center, MSP is paid by the center, the state can also announce bonus. The center announces MSP. The state can announce a bonus. And if you're a farmer who is selling the crop in this particular state, imagine the MSP is 1000 rupees. The bonus is another 200 rupees. Then as a farmer, you will be earning 1200 rupees. The farmer will be earning 1200 rupees in this particular state. This is another very important point. Now I have written 22 crops. Somebody will say, no sir, not 22, it should be 23, because in my book it says 23. Please understand that 22 crops MSP is announced and MSP is paid. The other crop that you are basically confused is sugarcane. The other basic crop that you are thinking of is sugarcane. Right? In the context of the sugarcane, please understand, announcement of FRP is done, fair and remunerative price. FRP stands for fair and remunerative price. FRP announcement is done by the center. The state can announce. The state announces state advisory price. Right? The state announces state advisory price. Center announces FRP. And generally it has been seen that the state advisory price is greater than FRP. And the farmer, when they sell the sugar cane to the mill owner, right, the SAP has to be paid by the mill owner to the farmer. Right? Is everybody able to understand? Right? The SAP, I hope you understand, SAP generally is greater. Sir, what if it is not greater? FRP is paid. But it has been seen that SAP is greater than the FRP, which means if a farmer will sell the sugar cane to the mill owner has to pay this particular price to the farmer. And that is the reason in the context of sugar cane, they don't use the term MSP, rather they use the term FRP. Is everybody okay? Please do let me know. Is everybody okay with the discussion of MSP so far? These are important points. Please be very, very careful. Please be very careful. Questions can be asked on the idea of a MSP. Now, apart from MSP, what are the other things that you need to understand in the agriculture sector? PDS. There is, right, a PDS, concept of a PDS. Saurabh is asking for exam 23 will be correct. My dear, CACP website says 22, go with 22. I am repeating, the CACP website says 22 and it's a government website. Right? If you want to basically contest, use the government website then. Right? So CACP website says 22, go with 22. And again, please understand, there is no constitutional requirement here. There is no law here. Tomorrow government can make it 25 also. Government can make it 26 also. Government can make it 18 also as well. It is entirely left to the government of India. Okay, next, PDS. What is a PDS? PDS basically stands for Public Distribution System. PDS stands for Public Distribution System. Now, what is this Public Distribution System? Public Distribution System refers to the network that is used by the government to distribute food grains. I'm giving a very simple example and simple statement, simple definition. Don't overcomplicate these definitions. What is a PDS? It is a network that is used by the government to distribute food grains. Sir, what do you mean by distribution of the food grains here? Let me take an example. I'm pretty sure all of you have heard of National Food Security Act 2013. National Food Security Act 2013. Under NFSA, the government of India right now has announced that the identified beneficiaries will be issued with 5 kgs of food grains, 5 kgs of food grains per person per month. And when I say beneficiaries here, under NFSA, listen to me carefully, there are 2 types of beneficiaries. Under NFSA, there are 2 types of beneficiaries. One is called as a priority household. Priority household. And the second type of a beneficiary is Antyodaya card holder. Antyodaya household. If you are an Antyodaya household, then in that particular case, per household, 35 kgs of food grain per month is given. If you are identified as a priority household, then essentially 5 kgs per person per month. Right? And who is identifying the beneficiaries? Listen carefully. Under NFSA, the argument is we will cover 2/3 of total India's population. 2/3 of total population of India. It will come somewhere in the range of, right, around 81 crore plus. 81 crore plus. Now, the government of India, using the census data of 2011, it has used the census data of 2011. After that, no census has been completed. Underline the term completed. Because I know lot of you have read today's article also on the, right, let's say mascots of the census, and they'll say, no, one more census is happening. I am saying the last census that was completed, population census 2011. So 2011 census data has been taken, and the center will decide what will be the number of beneficiaries in each of the states, and that is called as quota. Is everybody okay with the discussion so far? Center will decide quota for each of the state, and that is decided based on what? Taking the population of 2011. Now, once the quota has been decided by the center, the identification of the beneficiaries is done by the states. Identification of beneficiaries is done by the states. So the center will decide how many beneficiaries will be there. The state will decide who will be the beneficiary. Right? Is everybody okay with the idea? Center will decide how many. State will decide who will be the beneficiary. Done? Okay. Now, when I say under NFSA, you will have to be given 5 kgs of free food grains. Right? Because right now, till the end of, or till 2028, the issue price under NFSA is how much? Issue price is 0 rupees. Issue price is 0 rupees for, right, the per kg of food grains that is issued. So understand the logic here. When I need to distribute the food grains under NFSA, I need to have a system in place. I need to have food grain shops, that is fair price shops or ration shops. This network that is used by the government to distribute the food grains, it is called as public distribution system. Is everybody okay? This is called as public distribution system. This is the basic idea. Please be very careful. And let me explain step by step what is done by the government. Step number 1 is procurement. The step number 1 is procurement. And in the context of the procurement itself, in the current affairs, there are 2 terms. Please make a note. Please remember both of them. One is centralized procurement and the other one is decentralized procurement. Centralized and decentralized. What is the basic idea of a centralized and decentralized procurement? Centralized means Food Corporation of India will procure the food grains and pool the food grain. Pool means collect. That is called as a central pool of food grains. Sir, only Food Corporation of India? No. The state government can also use its agencies, purchase the food grain, hand over the food grain to FCI. Is everybody okay? Hand over the food grain to FCI, for which certain commission will be paid by the government. Right? This is called as a centralized procurement. Then there is a decentralized. In decentralized, the state government will procure food grain, will store the food grain, will distribute the food grain. Right? This is basically the idea of a decentralized procurement. Food Corporation of India will not come in picture here until and unless, please understand, until and unless the procurement done by the state is greater than what is the requirement in the state. Is everybody okay? Everybody is able to understand the logic here? Sir, how does the state government require how much procurement has to be done? My dear, look at the number of beneficiaries. Simple, look at the number of beneficiaries. In that state, let's say under NFSA, 10 beneficiaries are there. And all the 10 hypothetically are priority household beneficiaries. Which means per beneficiary 5 kg. Which also means 10 into 5, 50 kg. Procurement has to be 50 kg. So if the state under decentralized procures more than 50, then it will transfer it to FCI. Otherwise, what it will do? It will procure, store and distribute. That is essentially the concept of decentralized procurement. Everybody is okay? Right? What was there in the current affairs? Madhya Pradesh government is basically asking the central government to shift it from decentralized procurement to centralized procurement. Okay. Anyways, step number 1, procurement. Step number 2, after the procurement is done, food grains are allocated. Food grains are allocated either in the same state or to a different state. And now, once the food grains are received by the state governments, they have identified the beneficiary. Simple, they have identified the beneficiaries. Now, they will distribute the food grains to these particular beneficiaries using the fair price shops. The fair price shops, or else you can also use the term ration shops. So using the network of the fair price shops or the ration shops, the food grains now will be distributed to the beneficiaries. This is essentially how the public distribution system will work step by step. Is everybody okay with the discussion? Do let me know right now. Now, when all of this is being discussed, there will be one term called food subsidy. There will be one term called as food subsidy, right? What is this idea of a food subsidy? Let me explain that also. What is this idea of a food subsidy? Food subsidy essentially refers to the amount of expenditure that the government will incur for procurement as well as distribution of food grains. Right? I'll repeat the statement. What is a food subsidy? Amount of expenditure, that is how much government of India will incur in the form of expenditure for procurement as well as the distribution of food grains. That is called as food subsidy. Now, how do I calculate food subsidy? Simple. I will basically calculate how much is the MSP paid by the government, because when the government will procure food grains, they will have to pay MSP. That is an expenditure for the government. So how much is the expenditure in the form of MSP? Now, once the procurement is done, this is procurement cost. Is everybody okay? This is the procurement cost. If there is a bonus, you will add bonus as well. But let's say MSP. So once the procurement is done, there will be transportation of the food grains. Correct? The government has to hire some certain amount of labor to put the food grains in the bag. To, right, let's say load the food grains into the, right, let's say the truck or the vehicle. They will have to pay certain charges to the APMC, Mandi, etc. So there are procurement incidentals. Is everybody okay? There are procurement incidentals. That is one more expenditure. Now, the food grains will reach the godown. Food grains will reach the godown. Now again the labor will be used to unload the food grains. Put the food grains into a warehouse. Warehousing means again the cost will increase. Expenditure is incurred. From the warehouse, and now the food grains have to be transported to the villages. Now it has to be distributed to the beneficiaries. Again expenditure is incurred. All of this put together is called as distribution cost. All of this is called as distribution cost. Is everybody okay? To calculate MSP, to calculate the food subsidy, these are the different components that the government will consider, right, arriving at the total expenditure incurred by it for procurement as well as distribution purpose. Do let me know, everybody is okay with the formula here? The procurement cost, the procurement incidental, as well as the distribution cost. And when the government procures, please remember one more point here. When the government procures, all the food grain is not for distribution purposes. I'll repeat the statement. When the government procures, all the food grains that is procured is not for the distribution purposes immediately. There is also a component called as a buffer stock. There is also one more component called as buffer stock. What is this idea of a buffer stock? Compared to what we are supposed to distribute under the food security, right? How much we are supposed to distribute. In addition to that, I'll be purchasing more food grains. For example, let me continue the same number. 10 beneficiaries. And let's assume all the 10 are priority household beneficiaries, which means the government has to provide 10 into 5, 50 kgs of food grains. The government will not just purchase 50 kgs, it will purchase, let's say, 70 kgs of food grains. Why? What is the logic behind it? The additional 20 kgs of food grain, the government will simply say buffer, extra. And what is the use of the buffer? If there is any emergency, if there is any other requirement, government will use the buffer food grains, right, for that particular purpose. For example, if the Food Corporation of India will purchase the food grains and keep it with keep it with itself in the form of a buffer. Let's say there is very high rate of inflation. Let's say there is very high rate of inflation, and one of the drivers of inflation has been food inflation. And specifically within food inflation, let's assume wheat inflation is very high. So can the government of India through Food Corporation of India now use the buffer stock, supply the buffer stock, sell the buffer stock in the market under the open market sales scheme? Supply increases, market prices will cool down. Is everybody able to understand? So government will also use the buffer stock for these kind of purposes. Is everybody okay? Please do let me know. Is everybody okay? None of you are replying. Hundreds of the students are there in the session, but none of you are replying. Why? Sir, busy. Busy with eating, busy with WhatsApp, busy with checking who has stopped in the exam, whether my friend has cleared the exam or not. Right? But you be present in the class. Don't worry about what has happened with the last year, let's say, result. Focus on your results now. You are going to write the exams this year. Focus on that. Don't get distracted now. This is very crucial time period for you. Okay. Everybody is okay. So this is essentially how, right, the PDS system has been created. The food grains are procured. Food grains are distributed. How? Subsidy. Food subsidy is calculated by the government. Okay. Now let's go point by point here. Right. PDS, right, for distribution purposes, for undertaking procurement, storage, etc. The government of India set up an authority, Food Corporation of India. Please remember, FCI. FCI has been set up with the passage of FCI Act of 1964. It has started working from 1965-66 itself. FCI is a very important central government authority. Please remember. In fact, I told you one more authority's name earlier. The Commission for Agriculture Cost and Prices, CACP. In fact, CACP, please understand, CACP was also set up at this point only. At this point of time only, 1965. But please understand, earlier the name of the CACP was Agriculture Prices Commission, APC, Agriculture Prices Commission, 1965. And it is not set up under a statute of any sort, not a constitutional body as well. It is basically an attached office. It is basically an attached office under the Ministry of Agriculture. 1965, it was established. 1985, I repeat, 1985, the name was changed. In 1985, the name was changed from Agriculture Prices Commission to Commission for Agriculture Cost and Prices. Right? Since then, it has been functioning as CACP itself. Okay. Right. So, state will issue the license for setting up the ration shops or fair price shops. Right. The state government will issue the license, not the central government, state government. Remember that point as well. Okay. After this, NFSA 2013. What are the important points under NFSA 2013? I've already told you certain points. Let's revise and add more points. Point number 1. Right, under the NFSA 2013, the government of India will provide food security. Food security. And what do you mean by food security? Anybody can tell me what do you mean by food security? Food security essentially means 3 A's. Food security essentially means 3 A's. Availability of sufficient number of sufficient quantity of food grains, right? Accessibility to the food grains and affordability of the food grains. Is my statement clear to all of you? 3A, right? One is sufficient quantity of food grain, availability. Accessibility, these are accessible for the people. And the third one is affordability. right? The food grains are affordable, not too costly for the common man. That is the affordability. So the government basically says by providing the National Food Security Act under the provisions of the NFSA, we are going to ensure food grains are available, food grains are accessible and also affordable. And that is the precise reason why, to begin with, when the NFSA was implemented, the food grains were issued at very less prices. Rice was issued at 3 rupees per kg. Rice was issued at 3 rupees per kg. Wheat was issued at 2 rupees per kg. Coarse grains was issued at 1 rupees per kg. But the government of India now has reduced the issue prices of all these particular food grains to 0 rupees per kg, and that is till December 2028. That is till December 2028. And I know some of you might be thinking, sir, why? Is there any logic of reducing the issue price? To begin with, under NFSA, we had these kind of issue prices. Under NFSA, there is also provision which says after 3 years, the government can change the issue prices. Government has not done it, by the way. But during pandemic, the government of India announced a package by the name of Atmanirbhar Bharat package. Correct? Atmanirbhar Bharat package. Under the Atmanirbhar Bharat package, the government of India announced one more initiative, Pradhan Mantri Garib Kalyan Anna Yojana. PMGKAY, Pradhan Mantri Garib Kalyan Anna Yojana. Under Pradhan Mantri Garib Kalyan Anna Yojana, the government basically allocated additional food grains. Right? Whatever I was getting under NFSA plus 5 kgs of free food grains under Pradhan Mantri Garib Kalyan Anna Yojana. But after pandemic got over, the government of India simply said no need for allocation under PMGKAY plus allocation under NFSA. So they merged the PMGKY, brought it under NFSA, and since then the government till December 2028 has stated that the beneficiaries will get 5 kgs of free food grains till 2028. Now somebody will ask me, sir, what will happen after 2028? I also don't know, you also don't know. And let's pray, hope and wish. By then, you would have cleared the UPSC examination, become an IAS officer. Otherwise, right, basically now you'll have to update the information. Okay. Anyways, everybody is okay. So food security, 3 A's. 2/3 of the total population will be covered under the NFSA, 2/3. Right. And out of the 2/3, 50% will be the urban population, 50% urban population will be covered, and 75% rural population will be covered. 50% urban population, 75% rural population. And total population which has been covered under this is somewhere around 81 crore right now. I've already told you the beneficiaries under this are divided into 2 categories. One is the priority household and the second one is essentially the Antyodaya card holders. Priority 5 kgs per person per month. Antyodaya 35 kgs per household. Right? In addition to this, under this particular NFSA, the ration cards which are issued in the name of the eldest woman of the family. Eldest woman of the family. In addition to this, there is also provision which promotes adoption of information and communication technology, Aadhaar-based technology, etc. to make the system much more transparent. And there is also one provision which basically promotes, because of this, it promotes, right, let's say the transfer of the subsidies, right, in the form of a cash. Done? Everybody is okay? So these are certain important points in the context of food security. Can we go forward now? Please do let me know. Those present in the session, alive, awake, please give the confirmation. Can we go forward? I'm presuming that most of the things, most in the sense 99% of the things that I'm discussing is a revision for you. It should not be vice versa. That is 99% should not be new thing for you, which means you have not revised that. Right? Most of the things should be simply a revision for you. Okay, let's go forward. Warehousing. Who will provide warehousing in India? Essentially, the central government is involved in providing warehousing. For example, we have Food Corporation of India. State government is also involved in providing warehousing. We have State Warehousing Corporation. Private sector is also involved in providing warehousing. Right? For example, the ITC company. ITC company runs a very, very big program by the name of e-Chopal. It is also involved in warehousing, by the way. Right? So state government, central government, as well as the private sector. All of them are involved in providing warehousing facility. Now, in the context of warehousing, that is when you talk about Food Corporation of India, there is one committee recommendation. Please remember that. Right? That is Shanta Kumar Committee recommendations. Shanta Kumar Committee recommendations in the context of Food Corporation of India. Now, what are the recommendations of Shanta Kumar Committee? Let's go one by one. Shanta Kumar Committee basically says, one, if the state already has invested money, developed infrastructure. Infrastructure for what purpose? Procurement, distribution, etc. Then in such state, Food Corporation of India should simply hand over the work to the state government and move out. Simple, right? The state government should take up all this activity. Food Corporation of India should simply move out of the state. Why? State government already does the work. No need for duplication. Second, if a particular state government is announcing bonus over the MSP announced by the central government, then the center should not procure surplus food grains from the state. Reason which has been cited is very simple. The state which announces bonus, the farmers in that particular state will cultivate more of this crop. And because the farmers will cultivate more of this crop, there is imbalance that is created in the market because of it. Right? So center should not procure surplus food grains from this particular state if the state has announced bonus over MSP. Right? Whenever the center will procure the food grain, there has to be rationalization. Certain rational measures should be implemented when you procure the food grains. Right? When the center is announcing MSP for oil seeds, when the MSP is announced for pulses, then why the procurement is mainly centered around cereals? Because in India, most of the procurement is done for paddy and wheat. Most of the procurement is in the form of paddy and wheat. So this committee says, why? Then why are we announcing MSP for oil seeds? Why are we announcing MSP for pulses? In fact, when you look at the volatility, the prices are much more volatile in the context of pulses and oil seeds. Right? So prioritize, I repeat, prioritize procurement of pulses and oil seeds under MSP. That is one more very important recommendation of Shanta Kumar Committee. It also has recommended implementing cash-based subsidy. Cash-based subsidy, right, under the public distribution system. That is essentially the argument here is the government has implemented TReDS. Using this, government is providing, let's say, 5 kgs of free food grains. But what if beneficiary doesn't want, right, let's say, wheat this month? The beneficiary requires cooking oil. The beneficiary requires other pulses. Beneficiary requires other sources of protein. That kind of an option is not available under NFSA. So what can be done? Instead of incurring the subsidy expenditure and giving, right, let's say free food grains to the beneficiaries or subsidized food grain to the beneficiaries, why not simply provide the subsidy amount in the form of a cash into the bank account of the beneficiary? Into the bank account of the beneficiary. Right? So that now the beneficiary will determine what they want to purchase. Right? What they want to purchase from the market. That was the recommendation of the Shanta Kumar Committee, and the Government of India has actually implemented this. Is it okay? Government of India has actually implemented this in some of the union territories. Chandigarh, Daman and Diu, etc. In those places, this has been implemented. But now Government of India also has made one more very important reform very recently. And I'm pretty sure a lot of you are not aware of it. A lot of you are not aware of it. Right? What is the reform? The government of India has announced a voucher-based payment system of this particular subsidy. Voucher-based payment system in case of the food subsidy which is given in these union territories. This is a very important reform, a change which has been announced. Now let me ask you one more question, because I'm talking about certain connection to current affairs. Let me also check. First and foremost, please do let me know how many of you have read about Agriculture Infrastructure Fund. Agriculture Infrastructure Fund, AIF here is Agriculture Infrastructure Fund, not alternate investment funds. Don't simply say, sir, yes, you have covered already. Agriculture Infrastructure Fund. Okay, how many of you have read it? Please do let me know. Let me see. How many of you have read it? Only one person has replied so far. Others are waiting. Sir, I'm already a diplomat. I will not answer to you. I will wait for the question. I will see what you will do to others. Agriculture Infrastructure Fund? Most of you say yes. Great. Please tell me what is the funds allocated for the implementation of this particular scheme. What is the total funds which has been allocated by the government of India for the implementation of this particular scheme? Let me know. Agriculture Infrastructure Fund. Read, sir, but forgotten. Okay, Fund for Agriculture Infrastructure Creation like irrigation. ARS, my dear, please read it very carefully. Anushka Singh says 2 crore rupees. My question is, what is the total amount of funds which has been allocated by the government of India for the implementation of this particular scheme? It is being implemented from 2020-21 to 2032-33. That is for a duration of 13 years. So what is the total amount of funds which has been allocated by the government of India for the implementation of AIF? Most of the books will tell you 1 lakh crore rupees. Most of the books, and not just most, all the books whichever talk about this, they will tell you it is 1 lakh crore rupees. But please make an update. Take this as an update. It is not 1 lakh crore rupees now, it is 2 lakh crore rupees. It is not 1 lakh crore rupees, it is a 2 lakh crore rupees. Right? Somebody will say, sir, how? The Union Cabinet last week gave this approval. I'll repeat my statement. The Union Cabinet last week have given the approval to basically increase the funds allocated for Agriculture Infrastructure Fund from 1 lakh crore rupees to 2 lakh crore rupees. So everybody is able to understand. So keep on updating this. Keep on updating this kind of an information. Right, so let's go back to the earlier discussion. I was discussing Shanta Kumar Committee. I've also given you an update associated with recommendation of Shanta Kumar Committee. Is everybody okay? After this, centralized as well as a decentralized procurement. I've already covered what is centralized and decentralized. Now, there is one more very important area of agriculture, marketing. One more very important area of agriculture is marketing. Now, when you talk about marketing, please understand intrastate trade and commerce. Intra means within the state. Intrastate generally comes under the purview of the state government. Simple, state government. When you talk about interstate trade and commerce, of course, a central government will come into the picture. But when you say intra, that is within the state, it is under the purview of the state governments. And that is a precise reason when you talk about agriculture marketing. When you talk about agriculture marketing, the law related to agriculture marketing is framed by respective state governments. Does it make sense to all of you? Right? Does it make sense to all of you? The law associated with the, let's say agriculture marketing within the state, it has to come under the purview of the state government. And that is the precise reason the state governments will bring in law. This is called as APMC law or APMC Act. Agriculture Produce Market Committee. Agriculture Produce Market Committee, APMC law or APMC Act. And does it also mean every state in India has APMC law? Not necessary. Every state has APMC? Not necessary. It is a prerogative of the state government. Many states in India do not have any APMC right now. For example, Kerala doesn't have an APMC. Right? The state of Bihar does not have an APMC. It is entirely left to the prerogative of the state government whether to have or not to have an APMC. So far so good. Everybody is okay. It's not compulsory that you have APMC. It all depends on the requirement of the state. It also depends on the state government. Right? For example, the Bihar state government, earlier they had implemented APMC law. They felt that there is no requirement of an APMC law. They have withdrawn it. They have repealed it. Right? It is not applicable as of now. Okay. So let's go forward. APMC. Now, what is the basic model of a APMC? Under APMC, essentially what happens is the state government will identify a region. State government will identify a region and the crops cultivated in the region. The crops cultivated in the region. Now, these crops which are grown in the region will have to be brought to a mandi. Mandi is nothing but a market. These will have to be brought to the mandi or the market, and the buyers will come to the market and they will purchase the crops from the market. Is everybody okay with the sequencing here? Do let me know. Everybody is okay with the sequencing? The APMC law will give the power to the state to define the region, and within the region to notify certain crops. These crops now will have to be brought to the mandi or the market, and the buyers, right? What do you mean by buyers here? For example, let's say retailing companies, retailing giants, right? Or for that matter, let's say other traders, or for that matter, let's say food processing companies, etc. So all of them will come to this particular mandi and buy the crops according to their requirement, negotiate with the farmer and buy it from the mandi. This is essentially how the APMC or Agriculture Produce Market Committee actually will work. But please understand, there's a problem with this model. There's an issue with the model. What is the issue? These particular retailers, traders, food processing companies, etc., if they want to buy from different states, they will have to have different licenses. They will have to procure multiple licenses, and this is never good. And you're asking these particular buyers to physically come to the market, physically be present in the market, and basically negotiate. Bidding will happen and then come to a price agreement, etc. So what has happened is the government of India, instead of basically promoting this model now, is promoting one more version of this model, that is E-National Agriculture Market. ENAM. E-National Agriculture Market. E stands for electronic. Electronic National Agriculture Market. What happens under the model of ENAM? Very simple model. Under ENAM, we are going to integrate the APMC platform. APMC is on the same platform. Is it okay? We are going to integrate. Integrate means bring in the APMCs on the same platform. That is, as of now, more than 1,000 APMC mandis are integrated into the ENAM platform. Meaning what? If I'm the farmer, until now, I'll repeat the statement. If I'm the farmer, until now, I will take the crop to the mandi. You will, as a buyer, come to the mandi. Physically, both of us are present. Negotiations will happen, that is auctioning will happen, and a price discovery is done. But in the new mechanism, that is under the ENAM, you don't have to physically come to the market. Right? I will take the crop to the market. There is a platform, there is a right infrastructure. I will basically list my crops. I am registered farmer in the APMC. My APMC is also on the ENAM. Now, this particular crop will get listed in the platform. different buyers from different parts of India will start bidding for the crop. Is my point clear? Different buyers from different parts of India will start bidding for the crop. They will, right, basically compete with each other. Now, if I like the highest price, once I'm okay with the highest price, the bidding is stopped, then the agreement is, right, drawn. That basically both the sides will agree, the money is transferred, the food grains are transported. That is essentially the model of e-national agriculture market. This particular platform is maintained by Small Farmers Agribusiness Consortium, SFAC. Small Farmers Agribusiness Consortium. Right? It's basically, for example, right, those who are asking, is it a mega food park, etc.? My dear, all of you have purchased goods through Amazon app. Simple. You are sitting in one part of India. Sellers, multiple sellers are sitting in other parts of India. Both of them, right, that is buyer and seller, are meeting on a common platform, that is Amazon. Somebody will simply say, sir, only Amazon? No, Flipkart. Sir, only Flipkart? Not necessarily. You can keep on quoting a lot of apps now. That is not the objective. Objective is the buyers and sellers, whether they are from the same state or from a different state, they can basically, right, conduct a transaction over the eNAM platform. Is everybody okay? Right, so this is how eNAM platform actually promotes better price discovery. And a very important point is, listen to me carefully now. Earlier I said, if I want to participate in the mandis of the multiple states, I am supposed to take multiple licenses. I am forced to take multiple licenses because each of the state will have their own APMC law. But under the eNAM, I do not require multiple licenses. Only one pan-India license is sufficient. One pan-India license is sufficient to participate on the eNAM platform. Is everybody okay? Right, please do let me know. Is everybody okay? This is basically the idea of a eNAM. And again, before going forward, please do not imagine that it is something else, some other parallel marketing network, etc. No. APMC mandis are brought online now. That's it. Instead of having physical presence, physical is anyways there. But now the commodities can also be traded on the online platform. That is basically the model of eNAM. Okay, done? What about the quality? My dear, when you list the crop, there are conditions. It's not that anybody can list. It's not that any crop can be listed without giving any clarification, etc. All the right, let's say, documentation is there. Everything is there on the platform itself. Okay, can we go forward now? Right, so these are certain important concepts associated with agriculture sector. We have taken care of MSP, public distribution system, food security, warehousing, marketing. Right, so these are important concepts in the agriculture sector. And again, please understand, sir, current affairs, we are covering current affairs separately. Right, already from January 2025 to December 2025, current affairs is over. Right, we are supposed to cover the other current affairs, remaining current affairs, that will be done later. Don't worry, current affairs is a different, right, let's say, coverage. I'm covering only the static information here. Static information. Okay. Any doubts? If 3 laws had not been withdrawn, it would have been benefited from. Okay, my dear, whether you agree, disagree, doesn't matter now, because those particular 3 laws have been withdrawn. That's a fact. I hope you understand. You may be pro, you may be against, doesn't matter. Right? Those laws have been withdrawn. Don't enter into the political debate. Restrict to the economic concepts in economic class. Okay. Any other doubt? Please do let me know. Any other doubt? I've covered one more chapter now, agriculture. Okay. Target, PDS, APL, BPL and NFSA and merger. My dear, APL, BPL, please understand. Under the NFSA, we are targeting the beneficiaries. You can belong to APL also, that is above poverty line. You will be covered as a beneficiary. It's not that under NFSA only BPL is covered. No. Underline the term only BPL. No. That would essentially mean there are 81 crore people in India who are poor, that is below poverty line. So it's not that only BPL is covered, APL plus BPL. That's the reason I said, what are the identification criterias that are determined by the respective state governments, not the central government. Because from one region to another region, the development differs. From one region to another region, what is the level of, right, let's say earnings differ. That's the reason the state governments will determine who are the beneficiaries based on their own parameters. Right, so they will use the parameters, identify the right beneficiaries and provide the food grain. That is the reason it is targeted. Right, that is the reason it is targeted, and that was implemented from 2013. But during pandemic, in addition to NFSA, the government gave extra food grains under Pradhan Mantri Garib Kalyan Anna Yojana. So 5 kgs here, 5 kgs here. But after pandemic, government simply said, I can't give you, right, 2 extra entitlements like this. I will bring Pradhan Mantri Garib Kalyan Anna Yojana under NFSA like this. I will give you 5 kgs of free food grains till 2028. That is basically, right, the update. Okay. Sir, please give a small break before starting investment model to freshen up. Okay, good. Right. Saptashti, I'm presuming that I'm pronouncing the name correctly. If not, don't worry. My apologies. Dinner break. Okay. Under NFSA, can government procure food grains from their state but allocate it to other state? My dear, please understand. If the state government procures, it will not allocate to other state. No. If it is under centralized, state will procure, simply give it to FCI. FCI will take the food grains, put it in a pool called as a central pool. From the central pool, it will allocate food grains to the same state as well as other state. This is one. If it is under decentralized, the state has procured more than what it actually requires for distribution. This additional food grain, now it will give to Food Corporation of India. Additional, it will give to Food Corporation of India. Remaining, it will basically use it for distribution because anyways, it is a state government that is responsible for distribution purposes. Okay. What about the 25 kg at subsidized? No, my dear, I'm telling you, no. 5 kg under NFSA, 5 kg under, right, let's say, the Pradhan Mantri Garib Kalyan Anna Yojana. Understand the context. Context was this additional 5 kg was given because there was a pandemic. If pandemic is over, why should the government continue to give you 10 kgs? So government said, I will not give it. Pandemic is over. That's the reason they shifted this to, right, basically 5 kgs free of cost till 2028. Okay. Do farmers or buyers get charged in ENAM? Yes, charges are there. Okay. Done. Let's go forward. Right, another 10 minutes. Let's cover some more concepts for another 10 minutes. Then we can take the dinner break. Don't worry, I'll give you dinner break. Okay, let's go forward. Next, I'll be covering investment models. Right, important concepts associated with investment models. What are the different investments and again infrastructure as well as investment that I'll be covering? FDI, FPI, SEZ, Special Economic Zone, INVIT, right, ADR, GDR, P-Note, etc. Let's start with the first one. Whenever you talk about foreign investments, there are two very important types of investments. One is foreign direct investment and the other one is foreign portfolio investment. Okay, foreign direct investment, foreign portfolio investment. What is the basic idea of FDI and FPI? Listen to me very carefully now. Under FDI, the investment is done in physical assets. Under FDI, the investment is done in physical assets. Whereas, in case of FPI, the investments are done in financial assets. Investments are done in financial assets. Right, what do you mean by that? A foreign company will bring in, let's say, 100 crore rupees or $10 billion, whatever the number is. They will set up a manufacturing facility in India. They will enter into a joint venture with an Indian company and set up research and development facility in India. They will set up a service sector company in India. So everybody is able to understand what do I mean when I say investment in physical assets. Whereas the foreign portfolio investments, FPIs, they will bring money into India. And where do they invest it? They will take the money and invest and purchase the equity, that is the shares. They will invest and purchase equity, essentially the shares in the share market, that is in the stock market. Is it okay? Everybody is okay with the idea? Right? So FDI invest in physical assets. FPI will invest in financial assets. FDI generally is associated with multiplier effect. FD is associated with multiplier effect. What do you mean by multiplier effect? If you increase the investment by 1 rupee, by how many rupees the GDP will increase? Is my statement clear to all of you? If you increase your investment by 1 rupee, by how many rupees will your GDP increase? That is called as multiplier effect. The FDI has very high multiplier. And in fact, please remember this. The investment in capital is always having very high multiplier. Capital means assets. Simple. Investments in assets. Assets could be a company, assets could be a machine, assets could be a road, etc. So when you invest in creation of assets like this, the multiplier is always higher. Sir, what do you mean by higher here? According to the economic survey. Okay, I've taken classes for economic survey. If you have not seen that, at least watch it at a faster pace, at least now. If not, at least download the PPT and go through the PPT. I've dumped a lot of information from the survey in the PPT. Either ways, according to the economic survey, the multiplier effect in infrastructure investment is in the range of 2.5 to 3.5. 2.5 to 3.5, meaning what? If you invest 1 rupees in infrastructure, your GDP is going to increase by 2.5 rupees to 3.5 rupees. Right? So everybody is okay. FD is associated with multiplier effect. FPI will simply increase the capital in the stock market. It is going to increase the capital in the financial market. That's it. FDI focuses on earning profits, but by staying for longer duration. Is the statement clear? FDI focuses on profits. Of course, yes. Anybody wants to earn profit. Private sector, by default, they want to earn profit. Right? So FDI focuses on earning profit, but by staying for a longer duration. Whereas FPI, there is no concept of staying for this duration, that duration. FPIs are purely speculative driven. These are purely driven with speculation, driven by speculation. What do you mean by speculation? What could happen? Speculation simply is what could happen in the future. Right? Your speculation is that Indian stock market will take a hit. Indian economy will take a hit because of what is happening in West Asia. You will take your money and start, right, withdrawing money. Everybody is able to understand? You feel Indian economy will do very well. That is your speculation. You will bring your money and invest in India. So the FPIs are very much speculative in nature. And that's the reason FPI is also referred to as hot money. Is it okay? FPI is also referred to as hot money. Right? So these are certain very important distinctions in terms of comparison. These are the important distinctions between FDI and FPI. But please understand, what is the technical definition? What is the technical definition? How does Government of India simply distinguish between what is FDI and what is FPI? The technical definition used by the government has been given by a committee, Arvind Mayaram Committee. Arvind Mayaram Committee. What is the recommendation of Arvind Mayaram Committee? If the foreign investment, that is the investment by a foreign company, if it is at least 10% or 10 or at least 10%, 10 or at least 10%, In case of a listed company, then this will be classified as FDI. Simple, everybody is okay. It is classified as FDI. If it is up to 10%, that is again in a listed company, then this is classified as FPI. But again, there is one more condition. Here. What does the condition simply say? Imagine today you have invested, you're a foreign investor, you have purchased 9% in a listed company. You have purchased 9% of the shares in a listed company. If you give the guarantee to the government that in the next 12 months, your ownership, that is 9%, will be made at least 10%. That is 10 or more than 10. You have purchased 9% right now, but if you guarantee the government that you will increase it to 10%, 11%, right, 12% in the next 12 months, today itself, you will be classified as FDI. Is everybody okay? Today itself, you will be classified as FDI. Now, this is in the context of listed company. What about unlisted company? In case of unlisted company, any foreign investment used to purchase ownership, any foreign investment, any percentage, doesn't matter. Any foreign investment that is used to purchase ownership, that will be classified as FDI. That will be by default classified as FDI. This is basically the recommendation which was given by Arvind Mayram committee, and the government is using this recommendation as of now. Is everybody okay? Please do let me know. Everybody is okay with the discussion about, right, FDI now, FDI and FPI as of now? Sir, only the condition of 12 months? Yes, within 12 months you are supposed to increase it. Within 12 months you are supposed to increase it to 10 or more than 10%. If you increase it within 12 months, 10 or more than 10%, today itself, even though your investment is 9%, it will be classified as FDI. Okay, so let's do one thing. Time is 8:03. Time is 8:03. Let's take a dinner break now. Let's take dinner break. Okay, so dinner break time is, let's say, 8:03, 8:04. Let's take a break of 40 minutes. 40 minutes is sufficient, no, for you people? We will restart the session at 8:45. Okay, we will restart the session at 8:45. Join back, right, after 40 minutes. We'll restart, right, after 40 minutes, right? So time is already written, right? So let's start again at 8:45. Take a dinner break now. Okay, welcome back. Please give the confirmation that I'm audible and visible for all of you. I'm audible and visible for all of you. Please give the confirmation. Okay, great. Let's continue the discussion. So, for those of you who are thinking what is happening in the session, we are revising important chapters from the subject of Indian economy. And so far, what we have done is we have covered banking, remaining part of banking, that is done. After banking, we discussed one more chapter, financial market, that is done. After that, we have revised agriculture, over. We started with investment models. We will cover investment models. After that, certain important aspects of infrastructure and then employment and industries. Right. So that will be the scope of discussion in today's session. Let's begin that. So we are discussing FDI and FPI. Right. So before the break, what we discussed, what is essentially the difference between FDI and FPI? FDI focuses on investment in physical assets. FDI is there in a country or enters into a country to stay for a longer duration. The focus is on profitability, but in the process, it will have a multiplier effect as well. Whereas FPI is more focused on right profitability. The investments in FPI are speculative in nature. That is the reason it will keep on hopping from one market to another market, and that's the reason we call it as hot money. Okay, so now within FDI, let's talk about FDI. What are the different routes through which FDI can enter into a country? There are two routes. One is automatic route, and the other one is approval or government route. Approval or government route. What is the basic idea? The government of India will decide which of the sectors FDI is allowed without any approval. That is, a foreign investor doesn't require any kind of a permission to invest in this industry or in this particular sector. And it is the government of India which will also decide which are the sectors, which are these particular sectors where even before you invest $1, even before you invest any money, you are first supposed to take the permission of the government. And that is essentially going to, or that particular idea is going to be used as automatic route and approval route. Under automatic route, no permission required. You can bring in the money, invest, and remember this, within next 30 days. In the next 30 days, you'll have to give the information about your investment to Reserve Bank of India. In case of the approval or the government route, you bring in the money after taking the permission of the government. First take the approval and then you are allowed to bring in the money and invest in this particular sector. And within the government route, again, there are two types. Within the government route, there are again two types, right? One, when you want to invest up to 5,000 crore rupees. When you want to invest up to 5,000. And the second one, when you want to invest more than 5,000 crore rupees. Up to and more than 5,000. If you want to invest up to 5,000 crore, then you need to get the approvals by applying through a portal called as Foreign Investment Facilitation Portal. FIFP. Foreign Investment Facilitation Portal. And when you want to invest more than 5,000 crore rupees, then you will be given the approval from the Cabinet Committee on Economic Affairs. The CCA will give you the approval. But more importantly, please understand this. The government of India has issued a particular notice which is called as a Press Note 3. Please remember this. Very famous now, Press Note 3. Under the Press Note 3, the government of India simply says, if there is any investment that is going to come into India from its neighboring countries which share a land border with India. I'll repeat the statement. Any investment into India coming from the neighboring countries which share the land border with India, those investments will have to go through only approval route. No automatic route for them, only approval route. This is one more very important point. Very often this is cited in the newspaper. Please be aware of it. So how it can enter, how FDI can enter? Automatic route and approval route. Right? And there are ceilings. Ceiling means what is the maximum limit that is allowed. Maximum limit that is allowed. In some of the sectors, government allows up to 26% or up to 49%, up to 100%. Right? So from one sector to another sector, one industry to another industry, it is entirely the prerogative of the government. Again, I'm repeating, entirely the prerogative of the government to either to allow or disallow or basically prohibit inflow of foreign direct investment. Everybody is okay with the discussion on FDI? Now what about FPI? What is FPI? Foreign Portfolio Investment. And before the break, there was one student who was simply asking, where is FII then? What is FII? Please listen to me very carefully. According to the SEBI guidelines, FPI are essentially divided into two categories. Category 1 and Category 2. The FII that you are searching for, the foreign institutional investors or institutional investment that you are searching for, is essentially classified under one of the categories of FPI. So we have Category 1 where, right, let's say the institutions such as pension funds, sovereign wealth funds, etc. are classified. Right, there is Category 2 wherein, right, let's say individual investors, right, the investors such as family offices, corporate bodies, right, partnership, etc. These are covered under Category 2 of FPI. This is the classification of FPI according to Securities Exchange Board of India, according to SEBI. Okay, please remember the classification. Now, once you have looked at the classification, how is the FPI allowed to enter into the country? Right, there are different routes. I've listed some of them. Please have a look at it. One that I've listed is the medium term framework. Medium term framework. What is the idea of a medium term framework? The Government of India along with the Reserve Bank of India announced the medium term framework. Under the medium term framework to provide certain guarantees. Guarantees in terms of, right, what do you mean by that? In terms of certainty. Because very often we see that the Government of India or Reserve Bank of India will keep on altering the limits of investments to be done through the FPI route. They'll always keep on altering this route, and especially the limits when the foreign institutional investments or FPIs are doing the investments in the bond market. Because in the equity market, all of you know this, it is up to 10%. But in the bond market, if the foreign institutions make an investment, let's say in the corporate bond market, in the state development loans, in the union government bonds, very often there is a concern. The concern is, what if the foreign investors invest a lot of money today and they will start withdrawing the money tomorrow? That is, there is outgo of capital. Capital flight will take place. That will create a lot of uncertainty in the market. And that is the reason the limits are imposed by the RBI. Limits in terms of how much you are allowed to invest in bond market. But if these limits are altered, if these are changed very often, it also creates uncertainty for the foreign investor. So what the Government of India and RBI did was, they introduced a route called as medium term framework. Under the medium term framework, the government and RBI would announce certain limits of foreign investments into the bond market, and this limit would be applicable for the next 3 years. Is everybody okay? Please do let me know. After dinner is over, most of you have gone dormant. Those present in the session, please keep on confirming to me that you are awake. Please keep on, right, let's say basically give me a hope that you people are awake. So understand the right argument very carefully. The Reserve Bank of India under this would simply say, for the next 3 years, take the Government of India's bonds. Out of the total value of Government of India's bonds, maximum 5% foreign investment will be allowed to purchase Government of India's bonds. Maximum 5%. And take the state government bonds, that is state development loans. In the state development loans, in the next 3 years, only 2% of the total outstanding. Total outstanding means whatever is the value of the state government bonds. Maximum 2% would be allowed to be purchased by the foreign investors. This kind of a limitation was imposed under the concept of a medium term framework. Is everybody okay? Why? This was done in order to ensure that there is certainty in the policy making. For the next 3 years, doesn't matter 5%, doesn't matter 2% for the central government bonds as well as the state development loans. And after 3 years, gradually the limit would be increased. That is medium term framework. Now, in addition to medium term framework, there is also voluntary retention route and fully accessible route. In fact, this was there in the newspaper couple of days ago. Voluntary retention route. Now, what is voluntary retention route? I'll start using the short form of this, VRR. Under the voluntary retention route, the RBI, this was announced by RBI will allow foreign investors to invest in corporate bonds. The foreign investors will be allowed to invest in government bonds. But how much will be the investment? That will be annually decided by Reserve Bank of India. Is the point clear? Very simple idea. Don't overcomplicate everything here. Simple. The Reserve Bank of India would simply say, in this year, we will allow 2.5 lakh crore rupees. We will allow 2.5 lakh crore rupees of foreign investment in corporate bond market and in the government bond market. But what was the speciality about the voluntary retention route? If you want to invest under this route, you will have to guarantee to Reserve Bank of India that you will hold, listen to me carefully, you will hold at least 75% of your investment in India for at least 3 years. Is everybody okay? I'll repeat it again. If you want to invest under this particular route, because RBI would simply say, I'm not going to impose restrictions. You want to invest in government bonds? Bring in the money, invest in government bonds. You want to invest in corporate bonds? Bring in the money, invest in corporate bonds. But here is a condition. The investors voluntarily will have to guarantee to Reserve Bank of India that for the next at least 3 years, 3/4 of their investment will not be going out of India. And what would be the advantage of this kind of a, let's say, guarantee given by the foreign investors? The advantage is, let's say hypothetically, a foreign investor wants to invest, hypothetically, 100 crore rupees under this route. RBI says, okay, you invest. It also means out of 100 crore, for the next 3 years, 75 crore will not leave India. That would create, right, let's say, long-term investments. That would attract long-term investments into India's market. And that concern that there will be a capital flight. Suddenly, the foreign investors will take the money and move out of India. That kind of a capital flight concern to a very great extent would be addressed under the voluntary retention route. Is everybody okay with the VRR? But now RBI has made a change. What is a change? RBI now simply says, we do not want to impose this limit of 2.5 lakh crore rupees annually. Right now it is 2.5 lakh crore rupees. We want to remove this particular limit. Why? There is a lot of interest of the foreign investors to invest for longer duration in India. Right? That is an update. Please be very, very careful. Voluntary retention route. Then there is fully accessible route, FAR. Under fully accessible route, RBI will notify certain Government of India's bonds. I'll repeat the statement. Government of India's bonds, that is government bonds of the government bonds issued by the Union government. For example, when this was launched, couple of years ago, when this route was started by RBI identified 5-year government bonds, 10-year government bonds, 15-year government bonds, and 30-year government bonds. RBI notified these particular government bonds, and any foreign investor who wants to invest in these government bonds, there will be no restriction. There will be no conditions over their investments in these government bonds only. This would attract stable investments from the foreign market into the Government of India's bonds. And mind you, please remember this. Government of India's bonds are sought by foreign investors. It's not that they don't want to invest. They want to invest because if you look at what is the spread, spread essentially means yield. What is the yield of Government of India's bonds and Government of USA's bonds? Government of India's bonds offer a higher yield rate. So obviously, government guarantees the payment. Government of India has never defaulted on the repayment. So foreign investors are interested in investing in these kind of instruments. But because there were limitations earlier, now RBI simply says, I will remove the limitations. You want to invest in 5-year, 10-year, 15-year and 30-year government bonds, you can easily do it. But after some time, the RBI realized that most of the investments, that is 95% of the investments under the fully accessible route has gone into the 5-year bonds and 10-year bonds. And that is the reason the 30-year bonds, the 15-year bonds have been removed from the fully accessible route. Is everybody okay with the idea for FPI? Please do let me know. What are the different routes of, right, let's say the FDI and FPI? Those present in the session, please give the confirmation. Can we go forward now? Others, only 3 people have replied. Others are waiting for others' confirmation. Next is the special economic zone. Next idea or the next model is special economic zone. What is this idea of a special economic zone? A lot of you are very slow today. Very slow, very much, right, let's say concerned, very much, right, let's say inactive. Why? What is the reason? Generally in my session, when the people are present, they'll keep on replying very fast. They'll keep on asking a lot of questions. But today, the activity to a very great extent has gone down. Okay. Sir, RBI imposes limits on all kinds of bonds or SEBI also involved? RBI. Generally, it is RBI because dollars coming in, dollars going out. It is the Reserve Bank of India. Okay. Let's go forward. Special economic zone. What is the idea of a special economic zone? Let me explain. Special economic zones essentially are regions within India. I'll repeat, regions within India which are notified, right, as the special economic zone. Regions within India which are notified as special economic zone. What do you mean by this? The laws and regulations which are applicable for this particular region will be relaxed. Right? The regulations which are applicable for this region will be relaxed. What do I mean by that? Let me give you one example. Okay, SEC very commonly you will have come across or studied, but please do let me know now. All of you heard of GIFT IFSC? Please do let me know. GIFT IFSC, International Financial Services Center. GIFT IFSC, right? So Gujarat International Financial Tech, right? IFSC, International Financial Services Center. GIFT IFSC is very often cited in the newspaper. Please understand, GIFT IFSC is essentially nothing but a special economic zone. It is nothing but a special economic zone. Generally, what is the focus of SEC? A region will be identified. Let's say this is the region. Now, if this is notified as a special economic zone, you import something here, taxes are not applied. If you export, taxes are not applied. Right? So basically this is done in order to make the region much more competitive in terms of manufacturing and exporting. Simple. Produce something and export it. And because I'm providing you a lot of tax exemption, automatically you will become, or your products will become very competitive in the international market. That is the whole idea of SEC. But in addition to promotion of manufacturing, GIFT IFSC focuses on promotion of financial services. Please understand, it is more focused on promotion of financial services. What do you mean by financial services? Banking, stock market, insurance, right? All of these financial services are readily provided in the International Financial Services Center. And what is the logic of this? Logic is very simple. Listen to me very carefully. Imagine you're a billionaire. Okay, listen to me carefully now. Imagine you're a billionaire. A lot of you will become very happy, very active now. Why? Sir, I'm a billionaire. Let's say you want to invest in India's stock market. You will bring the money, convert the dollar into rupees, which means there are certain charges that you will have to pay. Invest that rupees into the India's stock market, earn certain profits. And when you earn certain profits, the government of India will impose taxes on your profits and collect certain taxes. Correct? will collect certain taxes. But what if I say there is certain region in India where stock market is there, lot of companies are listed there also. All you need to do is bring the dollars, invest dollars only. No need to convert. Right? I hope you understand. No need to convert. Invest dollars. And when you invest in the domestic market, that is, let's say in the Bombay Stock Exchange, National Stock Exchange, the moment you invest, certain amount of charges you will have to pay. For example, securities transaction tax. It was there very recently in the newspaper. Securities transaction tax. But in this IFSC, you make investment, don't pay taxes. You earn profits, don't pay taxes. You don't have to convert the dollar into rupees and then invest. You can directly invest the dollars only. So now tell me, if you are a foreign investor, don't you think for you it is preferable to invest in the IFSC rather than investing in the normal or within India's domestic territory stock exchange? Yes or no? Right? Please give the confirmation. If you're a foreign investor, which you are right now, by the way, you're a billionaire, by the way, you don't want to pay any taxes to the government, don't you think it makes more sense for you to invest in IFSC? Why? No security transaction tax. No need to convert your dollar into rupees. No charges. And once you earn profit, don't pay taxes on your profits. So obviously you will prefer to invest in the IFSC rather than investing in the BSE and NSE. And that's the reason earlier, if you remember, I said in the GIFT IFSC, we already have NSE International Exchange. Correct? You remember this particular term? I used it earlier in the context of green bonds. Right? Green bonds, I connected to blue bonds. And I said Sri Lanka's first blue bond has been listed in the Colombo Stock Exchange and also has been listed in the NSE International Exchange, which is located at GIFT IFSC. Which is located at GIFT IFSC. What is the logic? Right? Logic is simple. No need to convert, right? No need to pay taxes. Charges are very low, right? Negligible, many of the time zero, right? Very much, let's say, lot of relaxations are provided. Tax exemptions are provided. That is essentially the concept of GIFT IFSC, which is nothing but, I hope you understand, which is nothing but a type of special economic zone. Is everybody okay? And before I go forward with the other pointers associated with NSE, the GIFT IFSC is regulated by International Financial Services Center Authority, IFSCA, International Financial Services Authority. Okay. Whatever regulations have to be implemented there, it is, right, regulations are implemented by this authority. Okay, right. Anybody can tell me which committee recommended IFSC in India? Let me see. Which committee recommended IFSC, right, International Financial Services in India? Anybody knows the answer? Which committee? I'm repeating the question, by the way. Which committee recommended setting up or establishment of International Financial Services Center in India? Percy Mistry Committee. Percy Mistry Committee. Remember, can be asked in the prelims examination. Percy Mistry Committee. Okay, let's go back. Special Economic Zone. Right? What is the basic idea of a special economic zone? Certain region will be identified, notified as a special economic zone. Objective is promote manufacturing of goods, promote production of services, and export them. And that is the reason whenever anything is manufactured in the SEZ, there is an idea of a zero rating. There is an idea of zero rating. That is, in simple terms, in the final market price of the product which is supposed to be exported, the final market price, there is no component of taxation within that. There is no component of taxation within that. In fact, until now, until very recently, the SEZs were not even covered under RODTEP. Very recently, that is in the last year itself, the RODTEP extension has been provided to special economic zone units. Right? So these are certain important points. Which is the authority which is responsible, nodal ministry for the special economic zones in India? It is the Ministry of Commerce. It is a Ministry of Commerce. Right? And please understand, I'm adding one more current affairs point from the budget documents. The SEZ Act simply says, whenever a unit in the SEZ will try to sell anything in the domestic tariff area. What is the idea for domestic tariff area? Let me explain this with a simple example here. Imagine this is special economic zone. Is everybody okay? The checkered area, right? The area with crisscross or crossed lines is nothing but a special economic zone. Now the rest of the part, the rest of India, it is called as domestic tariff area. This is called as a domestic tariff area. If you are a unit which is present in the SEZ, you want to sell something in the domestic tariff area, the government of India will be simply treating this as an import. The government of India will treat this as an import, and right, the same taxes which are imposed on the import will be imposed on this particular product when you sell it in the domestic tariff area. But recently what has happened? The special economic zones have raised a concern. Right? Their concern is, one, you are treating the final product which I want to sell in the DTA as an imported product. So whatever tax exemption you have provided when I imported raw material, that tax exemption is much lower compared to the customs duties that you are imposing when I'm selling in the domestic tariff area. Right? That is one concern. Second concern is, I want to export it to USA. USA is imposing lot of tariffs now. I want to export to other markets. There are a lot of protectionist measures imposed in other markets as well. So Government of India in the recently announced budget has stated that when the unit from the SEZ will try to sell the product in the domestic tariff area, certain tax exemption or certain amount of tax reduction will be provided to them. You will have to wait and see how much, right, the benefit in terms of reduction in the tax will be announced by the Government of India going forward. Is everybody okay with the model of special economic zones? Please do let me know now. Is everyone okay with the model of special economic zone? Can I move on to the next one? Can I move on to the next one? Okay, done. So next, infrastructure investment trust. Right, have a look at this. Infrastructure investment trust. There are two types of new investment models. There are two types of new investment models. One is infrastructure investment trust and the second one is real estate investment trust. Both of them are regulated by SEBI. Both of them are regulated by SEBI, Securities Exchange Board of India. Now, what is the basic idea? The basic idea is, if I were to ask you, would you want to invest in, let's say, right, a shopping complex, a very big mall? Of course, all of you will simply say, yes, sir, I want to invest because the returns are also very, very high. But what if I say, you'll have to invest 100 crore rupees in a shopping mall? Now you'll simply say, sir, 100 crore rupees, I don't have so much amount of money. And your argument will be, if I had 100 crore rupees, why will I sit at 10 o'clock or at 9:15 listen to your boring economics lecture? I would not be doing that, you will say. Agreed. You're absolutely right. Agreed. So understand the logic here. The idea of investment in these kind of, let's say, mega projects, that is, let's say, road infrastructure, shopping complexes, real estate projects, etc. Everybody wants to invest, but the amount of investment that is required is very, very high. Right? So is there any idea where we can participate, we can pool in the money, invest in these kind of projects, and all of us earn certain returns from the investments in the project? SEBI says yes. There are two models right now, InvIT as well as RIT. InvIT stands for Infrastructure Investment Trust and RIT stands for Real Estate Investment Trust. Infrastructure Investment Trust will invest in different types of infrastructure projects. For example, they can invest in roads, they can invest in, right, let's say ports, they can invest in airports, etc. But when you say real estate investment trust, this investment of REIT will happen only in the real estate projects. Real estate. That is, it could be for housing purposes, it could be for commercial purposes, doesn't matter. But the investment under this shall be done only in the real estate projects. Now, what is the model? Model is very simple. Please listen to me carefully. In fact, I don't know how many of you have known this or how many of you know this. The government of India very recently has announced National Monetization Pipeline 2.0. Correct? For the next 5 years, the government of India has announced National Monetization Pipeline 2.0. Under this particular National Monetization Pipeline 2.0, one model that they are using, it was used earlier also, that is under NMP 1.0. It will be used under NMP 2.0 as well, that is basically InvIT, Infrastructure Investment Trust. For example, NHAI, National Highways Authority of India, is using the Infrastructure Investment Trust to monetize the national highways and generate lot of revenues. Now, what is the logic? Logic is simple. Listen to me carefully. All of us who are present in the class, all of us, we want to invest, let's say, in a commercial real estate. Not the housing, commercial real estate. Let's say, construct a shopping complex. So there is a company, right, which is involved in the development of these kind of projects. What the company will do is, they will set up a trust. Listen to the sequence here. The developer, the company which is involved in the development of these particular projects, they will set up a trust. Right? Now, the trust basically after being set up, they will issue units, instruments. Units is nothing but instruments. They will sell the units to you. They will sell the units to me. All of us will purchase. So when the units are sold to the investor, can I simply say the money will flow from the investor into the trust? Is everybody okay with the sequence so far? Please do let me know. Be awake and keep on answering. So investor will purchase the units. These are called as real estate infrastructure, the infrastructure trust units or REIT units. So all of us will purchase the units. Money will go into the trust. And remember, out of the total amount of money or out of the total value of the units which are sold, certain units will be purchased by the developer themselves. 15% has to be purchased by the developer themselves. That is, they will use a technical term. Listen to me now. They will use a technical term, sponsor. Is it okay? Right? They will use a technical term, sponsor. So the particular company, let's assume, right? Many of you ask me, sir, any real life example, right? Let's assume National Highways Authority of India. They have set up a trust, right? That is for roadways, but let's say RMZ, that is involved in the development of real estate. They will set up a trust like this, right? GMR, they are involved in the development of real estate. They will set up a trust like this. Prestige, right? They will set up a trust like this. So once they set up a trust, the units will be sold to the investors. That is instruments. They will be sold to the investor. All of us will purchase the units. We will pay money. But the developer which has set up the trust, they will also have to invest 15% of the money. Now, the money will be collected by the trust. This money will be invested, let's say, in different commercial real estate projects. Is everybody okay with the sequence? That money will be invested in different real estate commercial projects. And when they invest, they will generate revenue. According to SEBI guidelines, listen to the guidelines, UPSC has the tendency or the habit of asking these kind of questions. According to SEBI guidelines, once the money is collected, minimum 80% has to be invested in completed projects. Maximum 20%. Maximum 20% in ongoing projects. Ongoing means incomplete projects. Same is applicable for InvIT as well. Same is applicable for InvIT. Maximum 20% in incomplete or ongoing project and 80% in completed projects. Now, once they've invested, They will generate revenue, right? They will earn rental revenue, or in national highways, they will earn, let's say, toll revenue, etc. Whatever revenue is generated, 90% of the revenue, I repeat, 90% of the revenue now has to be given to the investors. 90% of the revenue has to be given to the investors. Is everybody okay? Please do let me know. Is everybody okay? This model is essentially used in other infrastructure projects, ports, airports, roads, etc. That is called as InvIT model. When it is used in the real estate, this model is called as a RIT model. Can we go forward now? Right? Can we go forward? Arey Baba, understand why the companies will use this. Why will you use this model? Can you invest 100 crore rupees in a commercial in real estate? You can't invest 100 crores. You don't have that amount. Why will a private sector company use this? Or why National Highways Authority of India will use it? Don't you think if the project requires 100 crore, the company alone is not investing 100 crore. It is alone not taking the complete investment burden. It is investing, let's say, 15 crore. It is collecting 85 crore rupees from all of us. Don't you think that is beneficial for the company as well? Right? So please understand that logic. Think from that particular viewpoint. Then you will understand why will the companies prefer, why National Highways Authority of India will prefer InvIT like this. Okay, done. Can we go forward now? So InvIT as well as RIT, both of them are new models of investment. Both of them are regulated under SEBI guidelines. SEBI regulates both of these models. Okay, right. Because I'm in this particular slide, let me cover the remaining two as well. One is NMP. What is NMP? National Monetization Pipeline. NMP stands for National Monetization Pipeline. What is this monetization pipeline? The government of India, I'll club that discussion with another model. The government of India has proposed one more type of a investment in infrastructure model, which is called as National Infrastructure Pipeline. Under National Infrastructure Pipeline, the government of India wants to invest more than 110 lakh crore rupees, more than 110 lakh crore rupees in more than 9,000 infrastructure projects. More than 9,000 infrastructure projects. But by now you must have understood, government alone cannot invest this 110 lakh crore rupees. Central government alone cannot invest. Because if you see the budget expenditure itself, the total expenditure in the budget, it is more than 40 lakh crore rupees, 45 lakh crore rupees for one full financial year. So how much is the investment proposal? More than 110 lakh crore rupees. So essentially under the NIP, the model simply says some investment will be done by the center, some investment will be done by the states, and the remaining will be done by the private sector. Remaining will be done by the private sector. All the three put together, 110 lakh crore rupees in the development of infrastructure projects. Mostly, right? I'll give you some examples. Most of these particular projects are concentrated in roadways, in railways, in the power sector. Railway, roadway, and power sector. So basically, there is a huge ask for investing in infrastructure. But the money that is required, from where does the government get all of this money? It's not a small amount. Even if you take around 40% will come from the center. If you take 40% out of 110 lakh crore rupees, it will be 44 lakh crore. 44 lakh crore investment only by the central government. It's a huge task. So Government of India is implementing one more model called as National Monetization Pipeline. National Monetization Pipeline. Under the National Monetization Pipeline, the first round has been implemented from 2022 to 2025. The first round has been implemented. Now the Government of India has announced the second iteration or second round, NMP 2.0, which is going to be implemented for the next 5 years. Under this, have a look at this, right? Under this, the Government of India simply says, the most important model I'm talking about, the government simply says there are a lot of infrastructure projects which are not utilized or underutilized. There is infrastructure, but we are not able to utilize the infrastructure correctly. For example, it could be port, it could be railway stations, it could be power stations, it could be roadways, etc. So Government of India simply says, we are going to monetize these assets. How? We will simply lease these assets out. We will lease out these particular assets to the private sector. And once the private sector will be starting to utilize these particular projects, they will have to give certain amount of money to Government of India. So that is essentially how the Government of India is utilizing the existing infrastructure projects to generate revenue so that the money can be utilized in the investment and the development of other infrastructure projects. So NMP1, NMP2 and National Infrastructure Pipeline. Is everybody okay with the different models here? Please do let me know in the chat section. Is everybody okay with the investment model? Right, the types of infrastructure models which are being used by the government, etc., etc. Yeah, please do let me know. NIP is development of new infrastructure projects. Ankit Panti, cleared sir, AR 678. Ankit, my dear, are you saying that you have cleared the examination, or you're basically telling that, sir, cleared everything in the discussion? Lotus, these are basically PPP models, right? Question mark. Yes, my dear, there are different models. This investment is also used, and the PPP models are also used by the government. Okay, let's go forward. Right, so SEZ is done, Infrastructure Investment Trust is done. Let's go forward. ADR and GDR. Concept of ADR and GDR. What is ADR? ADR stands for American Depository Receipt. GDR stands for Global Depository Receipt. In addition to this, there is also one more, IDR, Indian Depository Receipt. Okay, ADR, GDR and IDR. Okay, right. So what is this idea? Let me explain this one by one. Let's assume there is an Indian company. Okay, there is an Indian company with the name ABC. Okay, ABC. Now this particular Indian company wants to get listed in the USA market. They want to get listed in the US stock market. The process is bit complicated. The process is bit time consuming, right? And there is a lot of paperwork also involved. But the company ABC wants to get listed as soon as possible, very quickly, without too much of this kind of a work. Is there any other alternative route? Is there any other route that can be used by the Indian company to get the securities listed in the USA stock market? The route that these companies will take is called as American Depository Receipt. Right? American Depository Receipt. What will happen now? This Indian company will go to a bank, deposit shares with the bank. Now this particular bank will have an agreement with one more institution in America. Simple. One more institution in America. Now let's say there is one more financial institution in America. The bank has a tie-up with this financial institution. This financial institution in America will issue depository receipts. They will issue the depository receipts. Is everybody okay with the process here? But what is the meaning of this particular depository receipt? If you are in America, imagine you are in America, you will spend money, you will invest and purchase the depository receipt. It simply means instead of directly purchasing the shares of the Indian company ABC, you are purchasing the shares but in one more form. That is one more unit that represents the shares of the Indian company. Is everybody okay? Everybody is able to understand? Do let me know. I'll repeat it again. The ABC, rather than directly listing, will approach a bank, deposit the shares. Now, keeping these particular shares with the bank, the depository receipts which represent the shares. The depository receipts are nothing but instruments which will represent the shares of the company ABC are issued or listed in the American market. This route is called as American depository receipt. Is everybody okay? Sir, why these are called as American depository receipt? Because one, it was for the first time introduced in America. That's the reason ADRs are very famous. And second, because these instruments are getting listed in the American stock market. That's the reason this is called as American depository receipt. Is everybody okay with the concept of an ADR? RBI simply says the depository receipts are counted as a part of FDI. Right? The company which is issuing it, essentially it is attracting foreign investment. That is counted as a part of FDI. Is it okay? Now what is global depository receipt? Instead of listing the depository receipts in USA, what if I list the depository receipts in the European market? Simple. Other markets outside USA. Other markets. What if I list the instruments, that is the depository receipts, in the European market? In that case, it will be called as global depository receipts. Right? That in that case, it will be called as a global depository receipt. Now there is a third type, Indian depository receipt. What is this Indian depository receipt? Let's say an American company wants to issue depository receipts in India. In that case, these depository receipts which are issued in India are called as Indian depository receipts. Is everybody okay? Or an European company will issue depository receipts in India. In that case, it is called as Indian depository receipts. Right? So, depository receipts, one, global depository receipts. Any other market outside USA, we'll call this as GDR. Indian depository receipt, a foreign company issuing DR in India, that is called as IDR. Indian company issuing the depository receipts in America, ADR. But please understand the logic is in which market you are issuing. Don't assume that ADR always means Indian company issuing in America. No. What if, let's say, a company in the European market, a company from Europe will issue depository receipts in America. Because it is issued in America, it will be called as ADR. Any foreign company issuing DR, I repeat, any foreign company issuing a DR in India, it is called as Indian depository receipt. So that is a basic idea of a depository receipt. Then everybody is okay. Please do let me know now. ADR and GDR. IDR will not be FDI, my dear. It will be outflow of FDI. Right? That is a foreign company is raising investment from the foreign market. Indian company raising money from the foreign market. Foreign company raising money from Indian market. That is inflow and outflow. Okay, let's go forward. P note. What is the idea for P note? P note stands for participatory notes. P notes stands for participatory note. What is the idea for participatory note? Let me explain this. Participatory notes are essentially offshore derivative instruments. These are offshore derivative instruments. Offshore means what? Outside. Derivative means this instrument will derive its value from some other asset. Is my statement clear to all of you? I'll repeat it again. Derivative means this instrument doesn't have its own value. It will derive its value from one more asset. They use a technical term, underlying asset. What do you mean by this? Let me explain. Imagine you're a foreign investor. Okay, you're a foreign investor. You have lot of money. You want to invest in Indian stock market. You want to invest in Indian stock market. But there is a problem. What is the problem? Between you and the Indian stock market, there is a big brother, SEBI. Securities Exchange Board of India. SEBI simply will tell you, before you are allowed to invest in Indian stock market, first you'll have to register with me. You will have to get registration from the SEBI. Only then you are allowed to invest in Indian stock market. and that is mandatory. SEBI is the market regulator. But you are worried that this registration process will take time. It's a time consuming process. So is there any other alternative route for you where you want to invest in India, but you do not want to register with SEBI? Is there any other route for you? Yes, and that is called as a participatory note. That is called as participatory note or P note. What is this idea of a participatory note or a P note? Let's say there is a particular financial institution. For example, all of you heard of Standard Chartered Bank? Do let me know. Stanchart. In short, they will call this as Stanchart. Standard Chartered Bank. It's a financial institution. It is investing in India's market, right? Or for that matter, HSBC, which is also, right? Again, bank is there, but it is more of a financial institution which will have multiple subsidiaries investing in different markets. So let's assume these are already registered with SEBI because they are investing in India's market. They are already registered. So what HSBC will tell you is the HSBC is registered already with SEBI, which means it is allowed to invest in the Indian stock market. Now, you don't have to go to SEBI and get the approval. No, not required. No need to register. You can simply give your money to HSBC. HSBC will invest your money in Indian stock market. Everybody is okay? Please do let me know. You don't have to register with SEBI. You already have a financial institution which is already registered with SEBI. So you can simply transfer your money to this financial institution. They will invest in the Indian stock market. But please understand, because you have given money, you'll have to get certain piece of paper, right? You'll have to get certain instrument in return. Now, this financial institution will give you an instrument that is called as participatory note. That is referred to as participatory note. Now, you tell me, simple logic. You tell me, hypothetical example, you have given, I'm the financial institution, you have given 100 rupees to me. I will take the 100 rupees, purchase share of a company. Can I simply say the instrument that you're holding in hand basically has a value that is the market price of the share of the company that I've purchased from the India's market? Correct or not? Because, right, your 100 rupee is sitting in the form of, right, the share. If the market price of the share goes up, right, the value of the instrument that you're holding will go up. If the market price of the share that I'm holding, I've purchased using your money, goes down, your value of the instrument will also go down. So the instrument that is a P note that you are holding doesn't have any kind of an independent value. It will derive value from the market price of the share. Right? That's the reason I said P note is essentially an offshore derivative instrument. Is everybody okay with the explanation? Please do let me know. It is an offshore derivative instrument. Right? So these are certain important points in the context of P note. And you don't have to register with SEBI to invest in a P note. You can directly approach a financial institution, give your money to them, they will invest because they are already registered. Okay? Right, so final point under the investment model, Bilateral Investment Treaty, BIT, Bilateral Investment Treaty. What is this idea of a bilateral investment treaty? Basically, these are agreements which are signed between countries. These are nothing but agreements which are signed between the countries. And what is the importance of such kind of agreements? Let's say there is a particular company or an investor from USA who wants to invest in India. What is the guarantee that the government of India will not target this company and make changes to policies? Correct? Once they have done the investment, I can tweak my policy which will hurt the American investor, which will hurt, right, let's say the UK investors in India, which will hurt, let's say, Germany investors in India. So there is always a possibility that the governments can formulate a policy which will end up hurting certain investors coming from certain countries. In order to provide protection to them, in order to provide protection to these kind of investors, generally the countries will sign agreements, and that is called as bilateral investment treaties. Is everybody okay? Right. So these are essentially, right, one part and parcel of whenever the countries will start to attract, a part and parcel of the policies which are implemented by the governments whenever they want to attract more and more investments from the foreign markets into the domestic market. Okay. Now let's move on. Next chapter that I'll be covering is the industries. Okay. And those who are wondering, sir, how much more? I'm not able to contain. I want to sleep. How much more? Let me cover industries. Then we will cover, right, employment, and that's it. Okay. 2 more chapters. Don't worry. We will cover it. Right. And then we can close the session. And I hope all of you know this. There is one more marathon session of mine. Yes, all of you have checked this. There is one more marathon session of mine that is scheduled for the 24th of, right, the March. With that, right, in that particular marathon session, I'll cover the remaining topics. For example, exchange rates, the balance of payments. For example, the World Trade Organization, right, IMF, etc. I'll be covering the other important areas of international trade or external market. And with that, we will be covering all the important static information, static by the way, static information from the subject of Indian economy. Right. So please do not miss out that particular marathon session. And again, before I go forward, don't be in a hurry of writing down whatever I'm saying, whatever I'm discussing in the classroom. I will give you notes. Let the session get completed. I'll upload the PPT also. I'll give you the notes also. You can use it for revision purpose. Okay, let's go forward. Right. IAS.I5Y. IAS, I'm presuming I don't know whether it is LAS or IAS. IAS, right, dash I5I says a good night students and sir. Good night, my dear. Take care. Carry on. Okay, let's go forward. Others, focus on the discussion. Let's carry. Let's start the discussion. Industries. In the industries, what are the important areas I'll be covering? First and foremost, right, the very important area has to be MSME. MSME stands for micro, small, medium enterprise. Okay, micro, small, medium enterprise. What is this idea of a micro, small, medium enterprises? Earlier in India, when the government used to announce industrial policies, there was an industrial policy of 1948. There was an industrial policy of 1956. Then again, industrial policy of 73, 77, 80. Then the biggest industrial policy, that is LPG reforms of 1991. Earlier, for example, in the industrial policy of 1956, the concept of small industries, we used to refer to them as small scale industries. SSI, small scale industries. We used to call them as small scale industries based on the minimum amount of investment, that is 10 lakh rupees. But over a period of time, the government of India realized that it is not just sufficient to have one categorization of small scale like this. We need to expand and also bring in a new piece of legislation. That's the reason the government of India introduced a new category which is called as MSME, micro, small, medium enterprise. And not just that, the government also introduced MSME Act. The government also set up a new ministry for MSME. Right? So MSME definition has been given by the government. But to begin with, the definition for MSMEs which were manufacturing was different from MSMEs which were involved in the services sector. But the latest definition that has been announced by the government, there is no difference in the classification, that is in the definition for manufacturing MSMEs as well as service sector MSMEs. And what is the latest definition? Please have a look at the table here and don't write it down. It is already there in the PDF that is I'm using here. It is also there in the handout. Same definition. I will not change the numbers. Don't worry. Right. So what is the new definition for MSMEs in services sector as well as manufacturing sector? The investment as well as the turnover criteria is being used now. Investment as well as turnover criteria. Right. So for micro enterprises, the investment criteria is a 2.5 CR and the turnover criteria is a 10 CR. For small enterprises, it is 25 CR and 100 CR. And for medium enterprises, it is 125 CR and 500 CR. Right? So please understand, once, right, I think in 2024, there was a question asked on the definition of MSME. Right? Is there a possibility of this being asked again? Of course, yes. Of course, yes. There is always a possibility of question on MSME. How do you remember it? This is my trick. Please remember, this is how I remember. You can use this trick or any other trick. I simply remember only the first line. What is the first line? 2.5 CR and 10 CR. That's it. For micro enterprises, 2.5 CR and 10 CR. Multiply this by 10 times. It will become 25 CR and 100 CR. This is for small enterprises. Now, whatever the number you have received or you have got, multiply this by 5 times. Multiply this by 5 times, you will get 125 CR and you will get 500 CR. That is micro, small and medium enterprises. Is everybody okay? This is how I remember. And right, I hope you understand. I'm pretty sure a lot of you would have already observed and used the same trick. Doesn't matter whichever trick you're using, please remember 2.5, 10, 25, 100, 125 and 500. Right? So essentially, this is the new definition that the Government of India uses for classifying the manufacturing or service sector MSME units. Same definition for both manufacturing and services sector. Now, in this area, one important question that can be asked either in the prelims or mains examination is the reforms. It is the reforms. My suggestion is, in the current affairs, we have already discussed multiple reforms that the Government of India has undertaken in the context of MSME. We have discussed some reforms in the budget session, right? That is in the video on the budget on YouTube, as well as special classes on the budget. Some reforms I've also discussed in the economic survey classes. Some reforms I've already discussed in the current affairs session from January to December 2025. And couple of more when I take up the current affairs of remaining sessions or remaining months. My suggestion is, even if you have not seen, nothing wrong if you have not seen, I've given the notes for all these classes. All the classes I've given notes. Just focus on the reforms in those particular notes on MSME sector. Done? Okay, so reforms. Sir, what kind of reforms? It could be in the form of credit guarantee trust for micro and small enterprise. It is in the form of a TReDS system, trade receivables e-discounting system. It is under the concept of public procurement policy, where reservation has been provided to procure, reservation in the sense certain percentage has to be procured from the micro and small enterprises. Right? There are multiple reforms like this. Probability of question being asked from those areas are very, very high. Okay, so this is MSME. Now, in addition to that, one more area you should observe is the disinvestment. The disinvestment. What is the basic idea of a disinvestment? The Government of India has ownership in the central public sector enterprise. Central public sector enterprise, right? So certain ownership, certain percentage of ownership, the Government of India will sell away in the market and in return collect money. Simple idea. Certain percentage of shares the government will sell away in the market and collect a certain amount of money. That is basically called as disinvestment. Now, how disinvestment can be conducted? First and foremost, in the context of disinvestment, please remember, it is DIPAM, Department of Investment and Public Asset Management, which functions under the Ministry of Finance. Under the Ministry of Finance, this is the department which is right central or basically the nodal authority in the context of disinvestment. Now have a look at this. Have a look at this. Right, the disinvestment until very recently, by the way, please understand, as a model of generating revenue, as a method to generate revenue, the model of disinvestment was promoted under Industrial Policy of 1991. right? I hope you understand. Sir, why 1991? Why not it be before 1991? My dear, if you study the evolution of industrial policies in India, before the LPG reforms were announced, the government was focused on acquisition of the companies. The government was focused on nationalization of the companies. But after 1991, or with the announcement of the 1991 reforms, the government of India changed the policy. Is everybody able to understand? Connect the dots here. Some of you will have this kind of doubt. Sir, why 1991? Why not before 1991? Before 1991, the government was more focused on nationalization. Government would simply keep on nationalizing multiple sectors, multiple industries. But post 1991, the government of India said, no point of nationalization. Let's go for privatization. That's the reason I'm saying it was the industrial policy of 1991 which basically started the discussion about disinvestment in India. After this, there was a committee set up, Rangarajan Committee. Please remember this also. Rangarajan Committee, 1993. Rangarajan Committee in 1993 also recommended that government can sell around 49% in case they want to sell. They can go up to 49%, generate revenues. After this, there is again the CPSE policy, Public Sector Enterprise Policy 1999. All these are important, by the way. The Public Sector Enterprises Policy 1999, where again there was a promotion or basically identification of the industries into strategic as well as non-strategic, basically to promote the idea of a disinvestment. Because in the policy of 1999, I'll connect it to this one. Please be very careful. I'll connect it to the new disinvestment policy. In the policy of 1999, the government of India basically divided the sectors into strategic as well as non-strategic. Right? The strategic were atomic energy. The strategic sector was railways. The strategic sector was arms and ammunition. So government simply said, we can't give away the ownership. Let's continue holding ownership in this. But others, we can have a look. For example, new disinvestment policy. Everybody can see on the right side here. New disinvestment policy. This new disinvestment policy has been announced by the government back in the year 2021. In 2021, the new public sector enterprises, it's not right strategically or let's say technically stated as new disinvestment policy. They will call this as new public sector enterprises policy. Under this particular policy of 2021, the government of India again basically classified the sectors into strategic as well as non-strategic. Any industry which would be falling under the strategic, the government of India simply said, the maximum number of units we are going to own under this, maximum 4. Maximum 4. We will try to reduce it even below 4 also. But we will have minimum presence in those industries which are classified as strategic. And those which are classified as non-strategic, anything that is classified as non-strategic, the government simply said they will not have any kind of a presence in non-strategic. Right? That is the latest policy. The latest policy associated with the public sector. So it's not that suddenly the government of India is implementing disinvestment. It has been doing this for the last 3.5 decades. But in recent times, there is a change in the policy, in fact. The government of India is changing the policy now. Why? The government of India has not been able to generate sufficient amount of revenue by disinvesting. Right? There are multiple methods which the government of India has used. It has sold minimum stake in many of the companies. It has used ETF route to sell the ownership in many companies. It has even completely privatized some of the companies, for example, Air India, etc. But the problem has been the government of India has been keeping very high target annually, because until very recently, if you have observed it, and if you have not observed, nothing wrong with that, change has happened couple of years ago. The government of India, when the budget used to be presented, the government of India used to give specifically a target for disinvestment for that financial year. Is my statement clear? The government used to announce a specific target of revenue that they would be generating by conducting disinvestment. But the government has not been able to meet these particular targets for many, many years now. So, what has the government of India done? Specifically, they are not announcing separate targets for disinvestment. Right? Is everybody okay? They are specifically not announcing targets for disinvestment. In fact, in the budgeting exercise also, the change has been done. What is the change? Until very recently, there was a separate header, separate entry which was called as disinvestment receipts. Now that particular separate heading has been removed. The disinvestment is given as a part of the other capital receipts. So the argument is, yes, disinvestment as a tool has been used by the government. Multiple committees are there. Committees have recommended this. The policies have been changed to adopt to this. Right? And government has privatized a lot of companies under the policy, etc. But I hope you understand the logic here. The logic has been, in recent times, the government is slightly moving away from adopting the idea of a disinvestment as a main source of receipt generation. Everybody is okay? And one more important point here, National Investment Fund. National Investment Fund. What is this idea of a National Investment Fund which has been set up back in the year 2005? The government, when they will conduct the disinvestment, the proceeds of the disinvestment will be put in the National Investment Fund. It is basically a type of a public account. Please remember, it is basically a type of a public account. All of you understand the meaning of a public account? It is outside Consolidated Fund of India. And there are limited purposes for which money can be withdrawn from the National Investment Fund. Right? There are only limited purposes. For example, you can remove the money and spend for, let's say, capital expenditure in railways. You can take the money from this, that is the National Investment Fund, and invest in metro projects. You can take the money from this and invest in recapitalization of public sector banks. You can subscribe for the shares under the rights issues when the CPSE, Central Public Sector Enterprises, will conduct rights issues. You can invest this money in atomic energy projects. So there are very limited purposes for which the funds can be utilized from the National Investment Fund. Is everybody okay? Please do let me know. Can I go forward? Without your authorization, I will not go forward. I'll simply stand, keep on looking at, write your authorization in the chat section. Okay, so let's go forward. Don't worry. I know a lot of you are feeling sleepy. Right, stand up, right, rub your eyes, have a cup of coffee, switch off the AC, let the heat, right, start to pick up in your room. Automatically then tell me that you are feeling sleepy. Switch off the AC. Automatically you will realize that, right, sleeping is not an option anymore, right, because right, the temperature is so high right now. Anyways, let's go forward. IBC, right, Insolvency and Bankruptcy Code. Okay, Insolvency and Bankruptcy Code. What is the basic idea? Please understand. Under the Insolvency and Bankruptcy Code, essentially it is to resolve the issue of non-performing assets, NPA. Non-performing assets. What is the basic idea of an NPA? A borrower takes a loan, will default on the repayment. Simple. Right? Borrower takes a loan and will default on the repayment. And somebody will ask me, sir, default means on what? Is it default on the principal, default on the interest, or default on both of them? Doesn't matter. Doesn't matter. If you do not make the complete payment means the interest plus principal. Right? Complete payment, if you don't make it, the bank will simply wait for the next 90 days. And before I go forward, please understand the classification of NPAs could be different. For example, generally the books will say 90 days. But is it uniformly applicable? That is 90 days applicable uniformly for all the types of loans? No. Right? Most of the loans, it is 90 days. That is, the bank will wait for the next 90 days from the day of default. And if you do not make a payment after 90th day, this account will be classified as a NPA. But in the context of agriculture loans, it is not just 90 days. They generally use cropping seasons. For example, if you have taken a short-term loan, they will wait for 2 cropping seasons. If you have taken a long-term loan, they will wait for 1 cropping season. So if you do not make a repayment even after the end of the respective cropping seasons or cropping cycle, then they will classify that account as a non-performing asset. Done? Everybody is able to understand the logic here? So don't overcomplicate. Sometimes UPSC can confuse you people in the examination as well. So just be aware of all of this. Okay, now have a look at this. Right? Once, let's say, a corporate borrower has taken the loan, has defaulted on the loan. So what is the solution? Right now, these particular cases will go to the system that has been set up under Insolvency and Bankruptcy Code. Insolvency and Bankruptcy Code, IBC. Under IBC, what happens? Listen to the sequence here. Step number 1, either the lender or borrower. Either the lender or the borrower will approach NCLT, file an application. What is an NCLT? It's a statutory body, by the way. National Company Law Tribunal. National Company Law Tribunal. So either the lender, or the borrower will approach NCLT, file an application. Once the application has been accepted, the committee of creditors will be formed. The committee of creditors, that is basically the lenders, the committee of creditors will be formed. The committee of creditors will discuss, deliberate and decide whether to basically sell off this particular company to a new buyer or to liquidate the company. Simple. Is it okay? They will discuss and deliberate, and it is this committee of creditors who have to vote and decide. Right? So the committee of creditors will basically decide, whether the company has to be sold off to a new buyer or the company has to be liquidated. The first focus or the priority will be always to find a buyer. Simple. The first priority will always be to find a buyer so that there is no destruction of capital. The company will not be closed. The company will not be shut down permanently. That can have a ripple effect in the whole economy or in the whole supply chain system. So they will try to find a buyer. If no buyer can be found and if no decision can be taken, if no buyer is found, no option, liquidation. If the decision cannot be taken by the committee of creditors, in that case also liquidation. Why? Please listen to me carefully. According to the law, according to the provisions of the Insolvency and Bankruptcy Code, this particular process has to be done in 330 days. This has to be done in 330 days. Of course, yes, in reality, a lot of times it will take more than 330 days. Lot of, let's say, issues will crop up once the process will start. Some of you might be thinking, sir, why are you explaining all of it? Is it relevant for us? Was it mentioned in any case? I'll give you one example. All of you heard of the Jet Airways? Do let me know. All of you heard of Jet Airways. There was a point of time when Jet Airways was one of the major competitors in India's civil aviation market. It was one of the major competitor, by the way. Very recently, after 5 years, I repeat, after 5 years of this particular Jet Airways company being under the Insolvency and Bankruptcy Code, Supreme Court of India finally issued an order and stated, because we are not able to get any kind of a solution, it has been more than 5 years, we are not able to get any kind of a solution, let's liquidate this. Is it okay? We have tried everything. We have waited so many years. We have spent so much of time and energy on this. But we have not able to find a solution to this. So what is a alternative solution? let's liquidate it. That order was issued very recently by the court. Done, everybody is okay? Right, so focus will be, or the priority will be to find a committee of creditor, but if nobody comes forward, or if the committee of creditors cannot take a decision, in that case, by default, liquidation will be recommended. Done, everybody is okay? Right? So this is basically the idea of a insolvency and bankruptcy code. My dear, if the default value is much higher, if the recovery is much lower, it is essentially the lenders who have to bear the losses. That's it. It is essentially the lenders who will bear the losses. Obviously, you have given a loan, you are not able to recover. So who will bear the losses? Lenders. Then they will only bear the losses. There is no other option. Right? So, okay. Now, in addition to this, there are a couple of indices I want you people to be aware of. Right? One is IIP. Let's hope and pray. Let's hope and pray that the base year, the composition, etc. of IIP is not changed by the time you write exams. Because there is an expectation, the government of India has already announced as well, that they are going to change the base year of IIP. But let's wait and see. Let's wish that it will happen only, let's say, after your prelims is over. If it is done before your prelims, there is one more set of data for you to memorize. For example, now I'm pretty sure lot of you have already taken the notes of the CPI. You have toned the notes. You have done so much of, let's say, cutting, adding, etc., etc. You got so much frustrated with that idea. Why? The CPI base year has been changed. The table has been changed, etc. GDP. A lot of you had memorized so many things about GDP. Now a lot of things have to be omitted and now basically rewritten. Your memory disk has to be rewritten now. And so let's wait and see. I don't think so it will be done, but you never know. It can suddenly be thrown upon and the base year can be changed. But anyways, till then, IIP, ICI and PMI. Now please understand, IIP and ICI, both of them are published by government. Both of them are published by the government, whereas a PMI is published by a private sector entity. Okay, right? Basic idea. What is the basic idea? Index of industrial production. This is an indicator which is published monthly by National Statistics Office, by NSO. And what is the idea of the IIP? IIP essentially will measure the changes in the volume of production. IIP essentially will measure the changes in volume of production. There are three main sectors: mining, manufacturing and electricity. Mining, manufacturing and electricity, the base year for the calculation is 2011 and 12 and the highest weighted is manufacturing. Manufacturing has the highest weightage of 77%, and followed by this, the second highest is mining and the lowest is electricity. Please memorize the table. Don't waste your time in doing a PhD in all of this. Simply memorize the table. And what is the use of this? IIP, ICI and even PMI. All these are indices which are used for policy making. Simple. Which are used for policy making. That's it. So these are the indicators that will give you an indication of how economy is performing, how manufacturing is performing, how electricity sector is performing, how cement industry is performing, how steel is performing, etc. So those indicators are used for effective policy making by the government authorities. So this is index of industrial production. Now in addition to this, there is one more index that is published by Office of Economic Advisor, that is index of 8 core industries, ICI. Index of 8 core industries. What is this index of 8 core industries? Out of all the industries which are part of IIP, we identify the most important 8 industries. Is the point clear? Out of all the industries which are part of the IIP, we will identify the 8 most important industries and we will basically identify, we will estimate, we will basically collect the data and find out what is the change in the production volume in 8 industries. What are the 8 industries? You have fertilizer, natural gas, you have cement, steel, etc. So total 8 industries are taken, and we will measure the change in the output of these particular 8 industries. Hence, it is called as index of 8 industries. Be it IIP, be it ICI. Both are published by the government, both are published monthly, and that is used for policy making. Done? Everybody is okay? Please do let me know. One more indicator is Purchasing Managers Index, PMI. Purchasing Managers Index. And what is the basic idea of a PMI? Please understand, it is a survey based index. Point number one, it is a survey based index. What do you mean by survey based index? There are certain respondents, right? Basically the companies. We collect the data from companies, right? What kind of data? We basically collect the data regarding what has changed in terms of, let's say, production done by them. Have they increased their production compared to last month? Have they decreased their production? Have they maintained the same production, right? What is the order book, etc., etc. So it is a survey based data methodology or survey based collection methodology, where we will collect the data from all these respondents or participating companies. And once we collect it, we will create an index. Simple, we'll create an index. And according to this particular index, right, understand this. According to this particular index, if the outcome is 50, right, if the index number that you get is 50, it means there is no change in the production. There is no change in the production. It is the same as it was in the last month. If the PMI number is more than 50, then compared to last month, there is an increased production. If the PMI number is less than 50, then essentially, right, the production that is done is less than the reference time period. So instead of indexing it to 100, generally what we do is we index the number to 100. But here they have not indexed it to 100, they have simply indexed it to 50. More than 50, expansion. 50, same. Less than 50, contraction. Right? So this is also published every month, right? And that is basically representing what is happening in terms of production activity in the economy. Everybody is okay with the idea of a PMI? Please do let me know. And now a lot of you will be happy. Right? A lot of you will be happy now. Why? We have reached to the last part of today's discussion. Last part of today's discussion, that is employment. Now, before I start employment, listen to me very carefully. In employment, right, I don't know how many of you have joined my special classes or let's say the class on schemes, etc. I've covered lot of schemes, lot of current affairs associated with employment. My suggestion is I will discuss static portion which is relevant for UPSC GS paper 3 as well as the current affairs. As well as the prelims, right? But my suggestion is don't stop at this, add on the current affairs. Please read the current affairs. The notes are already there with you because the probability of question being asked from the employment are either from the very basic concepts, very basic concepts, or are from schemes. Right? Either of this question will be asked in the prelims. Now, sir, what about the mains examination? Of course, we should not be worried too much about the mains as of now. But is there a probability of question being asked even in the mains from this particular chapter? Of course, yes. For example, can there be a question asked on, let's say, the critical evaluation of labor codes? Already asked, but you never know. Repetition can happen. Or critical evaluation of, right, let's say, higher number of working hours in India. Should the focus be on the production, increasing production or increasing productivity in India? Right? The critical evaluation of gig economy in India. So these kind of questions can be asked in the mains examination, but we will discuss the mains aspects later, not now. So from the prelims perspective, what are the important points from the chapter of employment? Let's understand that. Okay. Now, different types of unemployment. What are the different types of unemployment? You have frictional, you have structural, cyclical, and seasonal. right? Frictional, structural, cyclical, and seasonal unemployment. What is the meaning of each one of them? The frictional plus structural, first and foremost, please remember, put together is called as natural rate of unemployment. Right? So, first and second, frictional plus structural, natural rate of unemployment. But what is the meaning of frictional? A person will quit a job and let's say after 10 days will join one more job. Is it okay? Right? Person will quit a job today and will join another company after 15 days. So can I simply say for 15 days, the person remained unemployed? Correct? Everybody is okay? For the 15 days, the person has remained unemployed. Right? That is essentially frictional unemployment. Frictional unemployment. Is everybody okay with frictional here? Sir, why? My dear, when you quit one job and join one more company, don't you think for some time you will remain unemployed? And again, it's not compulsory that you will always be unemployed, right? It could happen that you put on the papers in one company today and tomorrow you will join one more company. Then there is no unemployment. But for most of the people in India, they will quit the job today. Maybe after 3 months, they will get a job somewhere else. Maybe after, right, let's say 15 days, they will get a job somewhere else. So for whatever number of days, you are unemployed between two jobs, that unemployment is called as frictional unemployment. Okay, structural unemployment. Best example is happening right now in India as well as the global market. Whenever there is adoption of a technology, whenever there is introduction of a technology, can I simply say some of the skill sets will become obsolete? Do let me know. Whenever new technology is introduced, some of the skill sets will become outdated, obsolete, useless. These people will be removed from the job. That is called as structural unemployment. For example, right now, the layoff that is being done in software industry because of adoption of artificial intelligence. Is it okay? Right? Everybody is able to understand? That is structural unemployment. Third one is cyclical. Cyclical means what? Let's imagine a country will fall into recession. This is one of the cycles in the economy, correct? Country, that is economy, will not always be experiencing growth phase. It will experience growth, then there's a slowdown, then there is a recession. So imagine a country will fall into a recession. Because of that particular cycle right now, people will lose jobs. That is cyclical unemployment. That is cyclical unemployment. Right? And then there is a seasonal unemployment. Seasonal. Seasonal means what? Agriculture season. Best example, agriculture season, or for that matter, summer season, winter season, etc. Don't you think certain people will lose jobs after sowing season is over? Certain people will lose jobs. Certain people will lose jobs after, right, let's say harvesting season is over. Right? So when there's a change in the season like this, right, certain people will lose jobs and that is called as seasonal unemployment. Is everybody okay? Please do let me know. Sir, isn't structural also natural? My dear, I said 1 and 2 both are natural. This, can you see this particular bracket? Right, both are referred to as natural. Right, so these are some of the important types of unemployment. In addition to this, please understand there is also one more term, disguised unemployment. Disguised unemployment. What do you mean by disguised unemployment? Whenever the marginal productivity of labor, remember the technical term, whenever marginal productivity of labor is zero, marginal productivity of labor is zero, this is called as disguised unemployment. What do you mean by that? Right? What do you mean by that? Right? Listen to me carefully. A particular job requires 6 people. Now, instead of 6 people, you will employ 8 people. Best example, agriculture sector. Best example, agriculture sector. So particular job requires only 6, but you will have employed 6, 8 people, 9 people, 10 people. So can I simply say more than required number of people are working? More than required number of people are working. So even though 6 is required, even though you have hired 10 people, the 4 people are not adding to any kind of productivity. So whenever the marginal productivity means instead of 6 people, you have 7th person. Does the 7th person add to the productivity? No. Instead of 6 people, you will have 8 people. The additional 2 people, will they add to the productivity? No. So whenever the marginal productivity, that is increase or the change in the productivity is 0, that is called as disguised unemployment. Okay. Best example is agriculture sector. So in addition to unemployment, there are also types of underemployment. Suddenly UPSC can ask you about that as well. Please be very careful. Underemployment. What is this, right? Underemployment. There are 2 types of underemployment. One is called as disguised. One is called as a disguised underemployment, and the second one is called as hidden underemployment. Right? Hidden underemployment. Right? Example, or what do you mean by disguised the underemployment? Disguised underemployment, for example, let's say, right, I'm fully capable of working 9 hours a day. I can join a company today, I can work 9 hours every day. But these kind of full jobs, right, basically the full-time jobs, these are not available in the market anymore. The kind of jobs I'm searching, these kind of full-time jobs are not available. I can work for 9 hours, but do I work for 9 hours now? No, I will simply work part-time. Is it okay? I'll simply work part-time. I can't find the full-time job, I'll work part-time. So don't you think my capability is very high, but the economy is not able to fully utilize my capabilities? That is basically disguised underemployment. Is it okay? That is called as a disguised underemployment. Right? One more example or one more type of underemployment, hidden underemployment. Hidden. What do you mean by hidden underemployment? Best example for this is, let's assume, and this you can see multiple times in India, by the way. Let's say there is a government clerical job for which notification has been issued. Right? Let's say 4 or 5 jobs, government clerical jobs. For 4 or 5 government clerical jobs, let's say 1 lakh people will apply. Out of 1 lakh people, when you analyze their curriculum vitae, or when you look at their when you look at their study profile, you will see there are certain people who are holding PhDs. There are certain people who are holding double degrees and they've applied for these kind of jobs. Right? And I hope you understand, it's not just with the government jobs, you will also see the same in many other gig jobs as well. So don't you think here the capability of the person, the skill set of the person is very high. The skill sets of the person is very, very high. But right, they are applying or they are working for a particular job where the requirement of the skill sets is very, very low. Lower skill sets are required. Is everybody okay? This is basically an example of a hidden underemployment. So you will also see hidden underemployment, disguised underemployment. You will also come across open unemployment. Open unemployment. What is the idea of open unemployment? You purposely, right? You are capable. You have skill sets. You have qualification. But you do not want to work in the current situation. You purposely are keeping yourself out of the labor market. That is called as open unemployment. Is it okay? So there are different versions or different types of unemployment, underemployment, etc. Please be very careful. Questions have been asked in the past. They will be asked right in the year, this year as well. Okay. Now, whenever you talk about the employment and unemployment issue in India, okay, employment and unemployment issue in India, there will be a discussion associated with Jobless growth. Jobless growth. Right? Listen to me very carefully. Right? What do you mean by jobless growth? There is a term that I've written, employment elasticity. Employment elasticity. Right? What is this idea of a jobless growth? Jobless growth phenomenon basically represents a situation in the economy where the economy is experiencing high growth rate. The GDP is expanding fast, but the employment is not increasing fast, or the job generation is not happening very fast. How do I measure it? How do I basically say there's a jobless growth phenomenon? There is one ratio which is generally measured, and that is called as employment elasticity. Right? What is employment elasticity? Look at the ratio. Percentage job rate or job growth, percentage job growth or employment growth rate. Instead of this, I'll write it employment growth rate, employment growth rate divided by GDP growth rate. GDP growth rate. Is everybody okay with this particular formula now? Employment growth rate divided by GDP growth rate. We are simply measuring from one time to another time by how much percentage the GDP has increased, and during the same time period by how much percentage the jobs have increased. If the GDP has increased very fast, job generation is very slow, then the whole employment elasticity number will be low number. Is it okay? If the employment elasticity is very low, and in case of India, yes, it is true, by the way. Right? For example, for many years, employment elasticity was in the range of 0.2. It was in the range of 0.2, which means GDP has increased. That's a fact, by the way. GDP growth rate is there. But if the employment elasticity is low, it simply means the employment growth rate has been very slow. Right? So everybody is okay. Jobless growth can be measured using employment elasticity. That can be asked in the prelims examination. Now, when you talk about employment and unemployment, right, how do we measure it? How do we basically measure? For example, every month in the newspaper, those who are reading will know this, every month unemployment rate data is published. Every month it is published now. How so? Listen to me carefully now. Earlier, this was not the case in India. We used to have surveys which are conducted once every 5 years. Once every 5 years. Then we shifted from 5 year to once every quarter, once every financial year. But now the government of India, that is the Ministry of Statistics and Program Implementation, publishes monthly data. Monthly survey data, that is periodic labor force survey. Periodic labor force survey. Please remember this. It is published every month now. Unlike earlier it used to be published once every 3 months. Now it is published every month for urban as well as rural India. Right? So periodic labor force survey data is published for every month. Okay, so this is the measurement. Right? In addition to this, the labor code. Right? What is the basic idea of a labor code? Earlier, there were 29 labor laws of union government. 29. And please understand, these particular 29 labor codes were very old, by the way, outdated. Right? A lot of them were very much outdated labor codes. So what has the government of India done? In order to promote ease of doing business, in order to promote, let's say, the employment friendly, let's say labor laws, in order to reduce the burden on the companies which are involved in implementation of these labor laws, etc., the government of India has gone for rationalization. It has basically gone for rationalization of labor laws now. And as a result of this particular rationalization exercise conducted by the union government, the number of labor laws now have been consolidated from 29 to essentially 4 labor codes. Right? So from 29 to basically 4 labor codes. My suggestion, please remember the names of all the labor codes. Remember the names of all the labor codes and specifically the code on social security. Code on social security, and that is where there is a coverage that has been provided for gig workers in India. Is it okay? That is where the definition of gig work, platform work, is provided. Social security benefits have been provided for gig workers in India. Right? Done? Everybody's okay? And finally, the concept of moonlighting. Right? This was there in the current affairs last year, right? More of a current affairs topic. But anyways, what is the idea for moonlighting? Now, moonlighting essentially means you are working for a particular company. You are a full-time worker in a company. But now you will finish the work in this particular company, let's say from 9 to 6. You will basically close the work. You will log out of this particular job. And after this, you will basically join one more company's work. You will be working for one more company. And why are they using the term moonlighting in this particular context? The term moonlighting basically is used because traditionally, you are working from 9 to 6 in a company, and once you come out and start working for one more company, there is evening time, right? Moonlight. You are doing this work in a moonlight. Hence, this particular practice of working for two companies like this is called as moonlighting. Right? Essentially, that is the reason why it is called as a moonlighting. And the companies don't like it. Many companies in India have taken action and removed workers, citing that you are violating, right, let's say the company regulations. Right? But essentially, what can be asked in the prelims examination? The term moonlighting. What is the meaning of the term moonlighting can be asked in the prelims. Done? Okay. Right. So these are certain important things I wanted to discuss in the context of, right, let's say these particular chapters. Again, I'm saying this is more focused on the static portion. The focus of discussion has been more towards the static portion. Right? Current affairs of these particular topics have already been covered for January 2025 to December 2025. Already covered. Okay. We are left out with a couple of more months of current affairs that will be covered later. Don't worry. I'll cover and I'll also give you notes regarding that. Okay. So finally, if you have liked the discussion, do not forget to hit the like button. If you're yet to join our YouTube channel, kindly do it today or right now. And one more very important reminder, there is one more marathon session. Right? I hope you know this. I've told this earlier as well. There is one more marathon session, and I'll be taking that particular marathon session on 24th March 2026. And that will be the final marathon session to cover the static portion of Indian economy. Right? So that's it from my side. Take care. Do not worry about the PPT or the PDF as well as the notes of this particular session. Those will be made available to you very soon, right? Just download them, but more importantly, use it for revision purposes. Thank you. Have a great day. See you next time.